And government support for borrowers boost profit at Britain's biggest mortgage lender. Welcome back to the programme, everybody. Let's have a look at where these futures are then. They've been looking a little bit sluggish, but we've had plenty of corporate news reports to trade around, so we could see some upward movement on some of those corporates that we talked about ahead of the break. DAX futures pointing slightly to the upside. Elsewhere, we do see some downside risk. Oil prices looking a little bit different today from yesterday, and perhaps that's where we might see some downside in some of those energy names listed on the FTSE 100. We've got oil prices down by around 0.5% on WTI, just a little bit weaker on Brent. In terms of these individual markets then, let's get to the start of the European equity trading session. And we've got the FTSE 100 opening, but down just a 0.3% or so. So as usual, that's the first one out of the gates. Really interesting to see the way that US stocks rallied yesterday post Jay Powell's testimony. But then that positivity, that momentum, that strength in risk assets, certainly not filtering its way into the Asian session. Very different there, down by 1.9% on the MSCI Asia Pacific right now. We have weakness in Japan on the Nikkei and on the topics, weakness in Hong Kong, and very specifically around Hong Kong, there's news around the stamp duty, but this was much broader. The cost be down by 2.5%. We have Chinese markets looking weaker. So plenty of weakness to talk about when it comes to the Asian session. So that's something we need to consider when we think about where we are going on global stocks. Yes, we saw that rebound in US stocks yesterday, but things looking a little bit different in terms of the Asian session and here into Europe. So European equity markets opening pretty mixed, I guess. We're down by 0.1% now on the Stoxx 600. The IBEX is up a little. The DAX fairly flat. US stock futures are trending slightly lower as well. That's as investors balance the risk of stronger inflation driving global rates higher against the Federal Reserve's pledge to continue policy support. Joining us now is Trevor Greetham, Royal London Asset Management Head of Multi-Assets. Trevor, very good to speak to you. And I wonder how you give us your perspective on what we heard from Jay Powell and the messaging from the Fed at this point, because the messaging seemed to be, you know, we're still here, we're still providing the support to markets, the loose conditions that we've seen. But at the same time, there does seem to be a lot of concern about where the inflation dialogue takes us, about where Treasury yields are going to get to. And whilst Powell's words comforted US stock investors, the Asian session looks really weak. So give us your perspective on what we heard.
Well, I think there is some concern about what the rising bond yields mean for equity markets. In some cases, I think they're just a sign of recovery, and you'd expect stock markets to generally do pretty well as bond yields are rising. This was an opportunity for the Fed to sort of to say that the markets were running ahead of themselves and that the bond yields were too high. And that really wasn't the message they gave. The message they gave was they were nowhere near raising interest rates. You could see quite a lot of a further sell-off in long-dated Treasury bonds, steepening the yield curve a lot further than it's done already off the back of this statement. And I think that's the concern. We didn't see a further sell-off yesterday, but we didn't see a very big rally either in US Treasuries. And rising Treasury bond yields can put pressure on growth stocks like technology. They can put pressure on the emerging markets. And that I think is maybe what Asia is keying off at the moment. It's a loose policy for sure, but it's probably going to be loose policy that's more conducive to big gains in commodities and value sectors and cheaper markets like the UK than the US.
Okay, so the fact that we heard messaging that allows for the recent trades to continue, the steepening in the yield curve, the higher Treasury yields, the fact that we heard policies that would allow that to continue, that's why we're seeing maybe this negative reaction in risk assets, Trevor?
I think so. And I think there will be the real question this year, which is, are we going to see a year of further appreciation, or are we going to see a year of rotation? And I think it's a mixture between the two. We've got very loose fiscal and monetary policy. We've got a clear prospect of quite a strong, but an extremely strong economic recovery as social distancing eases over the next year or two. We don't know exactly how quickly that will work, but there is definitely light at the end of the tunnel with the fantastic news from the vaccine. So you'd expect risk assets to do pretty well. On the other hand, some of those risk assets have already done really well in anticipation of recovery. And some of them have done really well because of the low level of bond yields we're discounting future earnings at. So I think we could have this tussle this year between periods where the markets generally are rising and periods where it's the value sectors which are actually going up, and technology and growth sectors, because of the discount rate going up, could find themselves under pressure. Now, they're so big in the big indices, the growth sectors, that this might not be a great year for the stock market indices overall, especially, as I mentioned, markets like the US, where technology is about 30% of the index. But you could still see a big rotation where you're making a lot of money in commodities and in the sort of lockdown victims, if you like, which are starting to see the revenue hosepipe pointed back towards them.
Right, and so you talk about risk assets that did well with low levels of interest rates, and you talk there about technology stocks, Trevor, and of course we've seen technology stocks in the US under pressure in recent days. Does that make you want to pivot away from US assets?
Yes, I mean, we're not quite at that stage. So we are actually, in our multi-asset funds, we're very slightly overweight technology. We've been much more overweight in the past. We're very slightly overweight the US. Still quite good earnings numbers coming from the US. But where we've been adding more recently is places like Japan. And we've been covering over the last few months what was a big short position in the UK a year ago. So we're starting to add to sort of value areas. Japan is interesting because it's the only central bank out there that is explicitly capping 10-year yields through their actions. And as US Treasuries sell off, the yield spread widens, it weakens the yen, and that benefits the exporters. So if you're looking for value plays on the recovery that also have that extra currency kicker, then owning Japanese equities with currencies hedged or owning them through futures, we think makes quite a lot of sense.
Yeah, and interesting to think about places where we might see gains in yields limited. Just going back to the equity session we have in front of us then, Trevor. So the Asian session was really weak. Europe seemed to start with a bit of a wobble 6 or so minutes ago, but now recovering some of its stride. London underperforms, but we have some of the cyclicals moving to the upside. So chemicals is the best performing sector. Travel and leisure also doing pretty well. Are these the types of sectors that you might expect to do well if we pivot then away from technology and things that have been so popular during the height of the pandemic?
Well, yes. If you look at the performance generally of value stocks versus growth stocks, 2020 was a record year of underperformance for value sectors. So the elastic, if you like, is extremely stretched at the moment. So you generally expect those sort of lockdown victim sectors to be going up most of the time rather than down. I'd add to the list financials and energy stocks. And in our models, they come out very strong indeed. And financials tend to do better as the yield curve steepens, and US banks have been outperforming for some time. People think technology is still making the running, but actually looking at relative performance, technology versus the US market peaked out in August.
Okay, good to speak to you. Stay with us, Trevor. Thank you very much. Trevor Greetham, Royal London Asset Management, Head of Multi-Assets. He'll stay with us a little bit longer on the programme. Let's have a look at some of the stocks that are on the move this morning then. Lloyds Banking Group gaining after resuming its dividends. So we see moves to the upside, 2.4% higher. There's also been some reporting around the housing sector, which can have a knock-on impact to businesses such as Lloyds, which operate in the mortgage market, of course. And that's to be something to watch on the broader housing house builders, whether we see an extension of some of the tax breaks that have been awarded to that industry recently. Reckitt Benckiser up by just over 1%, higher after like-for-like sales beat estimates, and AstraZeneca falling on some vaccine concerns, down by 1.7%, although worth pointing out, of course, that that is not being provided for a profit during the pandemic. Now, coming up on the programme, oil has gained some 30% this year. It's a little bit weaker this morning. In fact, it's fairly flat this morning, but that has certainly been the direction of travel of late. Copper is near a 9-year high. We will discuss booming commodity markets next. This is Bloomberg. Welcome back to the European market open. 11 minutes into a trading session that looks slightly more positive than where we started. The London market being weighed down by heavyweights like HSBC and AstraZeneca. Both of those look weaker. Interesting to see this pivot through the European session to something a little bit firmer, a little bit more positive for risk assets, because that certainly wasn't the picture through Asia. And in fact, we just saw a red headline across the Bloomberg saying China traders sell a record $2.6 billion of Hong Kong stocks as Hong Kong exchange itself sinks. So this is to do with the budget that we heard from Hong Kong. They're introducing an increase in stamp duty tax on trading of stocks in Hong Kong. And so that is weighing on stocks in Hong Kong generally, but also specifically on the Hong Kong exchange itself. That particular stock is under pressure as a result of this. Having said all that, this seems to be the sell-off in Asia was much broader than just the Hong Kong story. We saw weakness in China, weakness in South Korea, weakness in Japan as well. And some people are suggesting that that could be to do with expectations of higher commodity prices. And let's talk about commodities right now, with prices hitting 8-year highs for some commodities as investors' appetite booms. Jeff Curry is head of commodities research at Goldman Sachs, and he spoke to Bloomberg about what's driving the potential supercycle.
Revenge of the old economy. We have not invested in old economy production capacity, in some cases 5 to 10 years. The reason why is returns in the new economy were so much better that capital got redirected towards tech. Then you overlay ESG issues on this, these sectors are severely starved of capital. You take oil, CapEx, depending on where you are in the world, was down 40 to 70% in the first half of last year.
Tell us about the metals. I mean, I understand copper, and we're, John and I are arguing about, Jeff Curry, let's stop the show. Do you quote London copper or do you quote Chicago copper?
London copper.
There you
goes back
go.
to 1788.
Very good. There we go, John Farrell. So copper we get. Copper's moving up. Tell us about the other metals where if price goes up, supply doesn't come on, does it?
Well, it takes anywhere from 5 to 10 years to bring on a new copper mine. It's the last of the old school commodities that you still dig out of the ground. And that's where we have the real demand push, because you have this green CapEx that's starting to begin to be, that's going to be behind this energy transition story, because we now have a blueprint for energy transition in the U.S., Europe, and China now, something we didn't have 8 weeks ago. We believe the CapEx spend associated with this green CapEx is going to be somewhere around $16 trillion over the next decade. Put that on par with China in the 2000s. China spent $10 trillion. So in real terms, about the same.
Jeff, we've got to talk about the energy transition story in just a moment. Let's just stay on the metals for a little bit. We have to talk about what's happened in the last 10 years as well. And it started with JS over at Rio Tinto, that shift away from volume to value. The lack of investment we've actually seen in the last decade off the back of the top of the last super cycle, Jeff. How profound is that when you start to think about the dynamics from here on out?
Well, I mean, all these stories have the exact same story. You had very low prices over the last decade, very poor returns in the sector, underinvestment, no demand. Now we're adding demand on top of no supply, and we're creating really tight markets, whether you're talking metals, energy, agriculture. And at the core of the demand story is where the stimulus is going. Stimulus over the previous decade operated through the wealth channel and benefited higher income households. Today, it's benefiting lower income households who spend more on commodities.
That was Jeff Curry, head of commodities research at Goldman Sachs, speaking to the surveillance team, of course. Now, Trevor Greetham, Royal London Asset Management head of multi-assets, is still with us. And I'd love to get your perspective, Trevor, on whether we are or are not seeing a commodity super cycle. How would you assess that one?
Well, I think we could well be. I mean, I've been a commodity believer in the multi-asset funds I've managed for Fidelity and then for Royal London. We've included commodities since 2005. And so the first sort of 3 years of that was the tail end of the last commodity super cycle, the period during which China was building a new Boston skyline in Shanghai every year and sucking in commodities. And Jeff Curry was referring to that $10 trillion that was spent by China on commodities then. We've had a long period of underinvestment. Then we've got COVID coming along and supercharging fiscal and monetary policy. And also, of course, the Democrat win in the US, meaning there'll be a lot more money directed on climate change initiatives and on infrastructure spending. So you've got very loose policy, likely to stay very loose for some time because nobody wants to tighten too soon, given the risks of further relapse with COVID. And you've got underinvestment. So commodities look very attractive to us. We think they have very good inflation hedge properties. And we think that there will be a return of investor demand. We've got very lonely over the last 10 years as commodity investors. Most of that time we've been underweight tactically versus our strategic weights. But if you speak to most funds out there at the moment, they just don't have commodities. And in some cases, they don't know how to invest in commodities. My feeling is that in 5 or 10 years' time, they will be clamoring to get the asset class.
Okay, so tell me where in commodities you have exposure or you want to see more exposure then, Trevor, because as we heard there, this is a sector starved of capital, but lots of people want to make sure they're putting their capital to work in a sort of green capex sense, and not all commodities will qualify there. Some might be disqualified on certain measures. So how do you make sure that you get the commodities investment right?
Well, a couple of things there. First, from an investment point of view, I think there's a very good case for the industrial metals, and that case is related to the spending that needs to happen because of the greening of the world economy. All commodity markets are on a journey to clean up their act in the same way that equity markets or fixed income markets are moving in that direction as well. So over time, you'll see more and more like that. For example, you can buy exchange-traded funds that track gold and are conflict-free gold And you're seeing moves by the exchanges like the London Metal Exchange to say people can't use their warehouses unless they follow particular ESG criteria. So I think you will see, an improvement in the way business is done in commodity markets as elsewhere. But I'd really emphasize the fact that when you invest in commodities, you're not actually investing in the companies that are doing the extraction. And institutional investors have a very powerful role in cleaning up the way that companies behave through their equity shareholdings. What you're investing in is the actual commodities themselves. And that's not for the faint-hearted. They can be quite volatile. Individual commodities in particular, like silver, can be wickedly volatile. You'll be pleased to hear that we tend to invest via the Bloomberg Commodity Index, which is a well-diversified index. It's actually less volatile than stocks.
Okay, well, that is good to hear. And in terms of taking a seat at that table then, Trevor, do you find as investors then, when it comes to businesses that maybe other investors don't want to go near because of ESG criteria, can you affect real change as shareholders?
I think it can affect real change, and we're seeing that all the time. You just have to look at the announcements and the actions being taken by companies in the extractive industries. But I'd emphasize it's the shareholders that can change that. They own these businesses.
Yeah, indeed, they own these businesses. Just to end then, you talked about industrial metals. I mean, where else in the commodity space? Because it doesn't seem to just be there that we're seeing these booming prices right now. Where else, Trevor, in commodities? And is it the commodities themselves or the companies that you are most interested in at this point?
Well, at the moment, we're overweight the energy sector tactically, so we think the companies are undervalued. At the same time, though, we're investing in this broad range of commodities. So it will be the energy sector, it will be industrial and precious metals and agriculture. And I think the main message here is that you've got a situation where real interest rates are negative around the world, in the US and elsewhere. You're going to get more inflation pressure building up, given the strength of the recovery coming through and the amount of stimulus. And yet central banks want to keep interest rates low. And so if you want to kind of express a desire to hedge yourself against inflation, very, very low or negative real interest rates tends to drive commodity prices higher. And you've got the demand kicker as well. I mean, I'm sure there'll be bumps along the way, no doubt about that. But I think there's a very strong outlook for commodities. And something which is a bit technical, but investors have lost money on the roll, rolling their futures contracts in the past. And at the moment, the roll is not losing you money. So spot prices go up because of demand that's feeding right through to investor returns.
Okay, Trevor, good point to leave it on. Thank you very much, Trevor Greetham, Royal London Asset Management Head of Multi-Assets. Trevor will be continuing his conversation with us on Bloomberg Radio. That's coming up at the top of the next hour. Coming up on this programme, though, Buying the Dip, Cathy Wood, the superstar head of ARK Investment Management, takes advantage of a tech share slump, snatching up Tesla stock after the plunge wiped out the EV maker's gains for the year. This is Bloomberg.
We're very positive on Bitcoin. Again, very happy to see a healthy correction here. No market is straight up. Everyone should know that. Everyone should have some dry powder for days like these. And I've been saying that for a while.
After that endorsement from Cathie Wood, the largest cryptocurrency climbed back above $50,000. Joining us now to discuss is Bloomberg's Danny Berger. Danny, so Wood says that she still likes Bitcoin. What moves did she actually make with her fund?
So she did buy the dip in Bitcoin. We don't know exactly how much, but of course she did tell Bloomberg that she went back in and bought it. And we saw the reaction from Bitcoin prices. She's also bought the dip in Tesla as well. Now this we see the exact amount. 3 of her ARK funds bought Tesla, about 240,000 shares worth. And Tesla did get a bump in aftermarket trading. I think this really is a testament to the almost cult-like following that Cathie Wood has. Her ARK investments are extremely popular. They've kind of replaced FANG in terms of when you think of the example of the momentum trade, you now think of ARK. So this just shows she is not a fair weather momentum bettor. She's going in, she's buying these again, and we're seeing the reaction in the underlying assets themselves as well.
Yeah, and she's known for one fund in particular, at least her main fund is a $27 billion ARK Innovation ETF. What has been the reaction of investors who put money into that ETF, of her buying more Bitcoin, of her buying more Tesla, or is it just reaction to the sell-off that we saw in tech names?
The reaction does look to be of the sell-off itself. It's actually pretty rare that this ARK fund, ARKK is the ticker, sees outflows, but we saw record outflows coming from it yesterday, more than $460 million worth. That's more than 3 times the previous records. I mean, look at these flows. They are pretty remarkable. Even in the middle of the March correction, when you see this extreme sell-off, it's getting a lot of money piled into it. So, of course, one day doesn't make a trend. This doesn't mean everyone who used to love ARK no longer does. It probably is just a reaction, as you say, Anna, to the sell-off in the big tech names we saw. Now, does this mean people are going to be excited that she's buying the dip and they'll buy the dip in ARK as well? Of course, we'll have to see so far today, but the fact that we've gotten positive reactions from both Bitcoin and Tesla, I think, is a good testament to the excitement behind these momentum strategies, Anna.
Yeah, a really interesting, a really substantial move, it seems, in appetite inflows behind her ARK ETF, or that particular ETF, Danny, and certainly somebody who plays well on the Bloomberg terminal, gets a lot of hits, those kind of stories. So we'll keep following her moves and interest in them. Danny, thank you very much. Danny Berger. Coming up on the program, can real assets keep up with other asset classes when it comes to climate change targets? We'll put that question to Xuan Chan, head of ESG real assets at L&G Investment Management. This is Bloomberg. Welcome back to the European Market Open. 30 minutes into a trading session that's increasingly positive. The London market weighed down, as I said earlier, by some heavyweight names. The likes of HSBC and AstraZeneca move lower, so it's difficult to make headway in London. The DAX is up by 0.5%. The chemical sector doing very well. Let's bring up the GRR and show you where the sector gains and losses are. And in terms of the move to the upside, chemicals is doing well. Solvay putting out some decent numbers, so that's lifting that sector in particular. Also some M&A in that sector to speak of, and we did a little bit earlier on. Media is the worst performing sector, and even as we talk about a continuation perhaps of a steepening yield curve, the banking sector underperforms today, so it is one of those losers. But the gains might not be stellar for European equity markets, but certainly the balance of gains and losses from a sector perspective is to the upside. Let's get a Bloomberg First Word News update. For that, here's Laura Wright. Laura.
Thanks, Anna. Chancellor Angela Merkel is warning that Germany is facing a third wave of coronavirus infections. She's urging caution as the country moves to reopen schools and businesses. Federal and state officials have proposed a variety of different plans for exiting the current lockdown, leading to confusion over what's happening next. AstraZeneca is said to have told the EU it will deliver less than half of the COVID-19 vaccines it committed to supply in the second quarter. Bloomberg sources confirm a report by Reuters that Astra now plans to provide less than 90 million doses, down from an expected 180 million. AstraZeneca says its delivery forecasts are in line with its contract with the EU. Tiger Woods has been injured in a solo car crash near Los Angeles after his SUV rolled over. The golf star suffered multiple leg injuries and had to be cut free and needed surgery. The sheriff says there's no sign he was impaired when he crashed. Aerial shots show the car on its side, having suffered significant damage. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Laura Wright here in London. Now, ahead of the COP26 climate change conference in November, investor attention is turning to the carbon footprint across different industries. But can real estate assets keep up with other asset classes on climate targets? Our next guest and her team at LGIM Real Assets have created a roadmap for zero carbon real estate assets by 2050. She argues that asset owners, like landlords, can control factors that should allow for a 60% reduction in carbon emissions by 2030. Xuan Chan, Legal and General Investment Management Head of ESG Real Assets, joins us now. Xuan, good to speak to you. So we're talking here about investments in property, in infrastructure, and you suggest that this asset class can meet ESG targets. Tell us about the framework that you put together.
Well, first of all, we have to remember that real assets is about investing in the real economy. So it's about investing in the built environment, infrastructure, and that's true the delivery of buildings and facilities, power regeneration, transportation, digital and social infrastructure, and essentially homes. So this is vital, we think. Real assets is absolutely consistent with aligning investor portfolios towards achieving net zero.
Okay, and you say that, I mean, this is an asset class that's been increasingly attractive in a search for yield environment, Xuan, and the yield's still available to slightly more illiquid assets, pushing some people into these investments for the first time maybe. But there are a number of third parties involved here. So if you're buying real estate, there might be tenants involved. I mean, how do you go about having those conversations around ESG in real assets when you're not fully in control of how an asset is used?
So you're right. I mean, achieving our climate change goals requires a huge effort of collaboration across our organization with external partners to achieving and future-proofing essentially our assets. So we are working very closely with all these multiple stakeholders, from obviously our colleagues, the designers and developers of our buildings, the managing agents and facilities managers, and the most pivotal collaboration are with our occupiers, as you say. More than half of the properties that we have in our portfolio, and it's a very large portfolio of more than 700 assets across the UK, are independently managed and operated by our occupiers. So looking ahead, very much as part of our roadmap, is a much deeper level of engagement and collaboration with these occupiers, and it's absolutely necessary to achieve our net zero objectives. And we believe that they are absolutely aligned in getting to these targets with us.
And Xuan, as we head towards COP26 in November, do you think the built environment is getting enough attention when it comes to greening of economies, both here in the UK and elsewhere?
I absolutely think so. You know, real assets, like I said, it's about investing in the real economy. So it's playing a very pivotal role in getting us to that final objective. I mean, you only need to look at, you know, our ex-governor of Bank of England, Mark Carney, who is a frequent guest of your show, and where he is now as vice chair of a very large global real assets player. So we believe it's absolutely consistent with aligning portfolios to net zero, because we are long-term investors and we are investing in the real economy, looking at long-term results and outcomes.
And in terms of the infrastructure opportunities, there are certainly a lot of governments around the world, Western governments, talking about channeling infrastructure spending, boosting, you know, fiscal boosts coming through that channel and trying to make sure that those investments are green. What kind of opportunities in the infrastructure space then do you find exciting, Xuan?
Well, there are so many, right? So the first thing, when we talk about what's happening at the end of the year, which is COP26 in Glasgow, is that we have to recognize this is going to be one of the most important climate summits since the landmark Paris Agreement back in 2015. And as investors, we're going to expect to see government policies and regulations really stepping up to align with climate goals. And that we expect from a real asset perspective that these regulations and policies will help orient investments into more greener infrastructure assets. And we think it's very much aligned as well with the fact that we have a huge challenge in rebuilding our economy from one of the worst economic crises as a result of the pandemic. So it's about building back better, and it's about building back a long-term green economic recovery and an equitable transition.
Okay, thanks very much for joining us. Good to speak to you. Xuan Chan, Legal and General Investment Management Head of ESG in Real Assets. Really interesting confluence of topics there. Coming up on the programme, we stick with that green theme, but this time in private equity. We speak with the co-founder of TKO Capital, the alternative investment fund that oversees more than 28 billion euros. That conversation next. This is Bloomberg. The European market open 40 minutes into a trading session this Wednesday that looks actually fairly mixed for European stocks. The CAC 40 and the FTSE 100 underperform. The FTSE 100 in particular, some heavyweight names dragging us lower there. The DAX up by 0.4%. Chemical stocks doing well today. So that leaves us fairly flat in total. Let's get a Bloomberg Business Flash. Here's Laura Wright.
Thanks, Anna. Private equity firm CVC is said to be exploring a bid for UK chemical producer Synthomer. Bloomberg sources say it's made an initial approach to gauge interest in a deal. Shares in Synthomer have risen nearly 50% over the past 12 months, giving the latex maker a market value of about £2 billion. Synthomer says it isn't in talks over an offer for the company. GameStop's board has pushed out CFO Jim Bell to speed along the strategic shift at the firm. Bloomberg sources say they want to make way for a new finance chief who shares their vision of transforming the company from a brick-and-mortar retailer into an e-commerce firm. GameStop shares are trading at about $45 after hitting over $480 during the frenzy in January. US aviation regulators are ordering new inspections to ensure the engines on Boeing's 777s are safe. That's after one broke apart over a Denver suburb shortly after takeoff. A new directive says the titanium blades on certain Pratt & Whitney models have to be examined by a special test before they can return to service. That's your Bloomberg Business Flash. Anna.
Laura, thank you. Laura Wright here in London. Now, it's been a busy few days for France's TKO Capital. Last week, the asset manager announced a SPAC with Jean-Pierre Moustier and Bernard Arnault. Then yesterday, the firm revealed that it has raised more than €1 billion for its first private equity green energy fund. Here with this week's Money Undercover segment is Danny Berger. Danny.
Anna, thanks so much. Well, I'm thrilled to say that joining me is someone who knows all about that busy period and no doubt has been busy himself. It's TKO co-founder Antoine Flammarion. Antoine, first off, thank you so much for joining us. And congratulations on raising this huge green energy fund. I'm wondering, when you were fundraising for it and the idea behind it, how much of it is about the opportunity and returns in the green space versus the shift towards more principled and social responsibility investing?
Hello, Danny. Thanks again for having us. It's very clear. We announced this fund yesterday, but we started almost 2 years ago our energy transition practice. So, it's not following the trend. It's making sure we had very strong conviction. And obviously, the world is changing fast, very fast after this pandemic. And, for us, it's really at the heart, at the DNA of the firm. So, we've been investing in the space for quite some time, and we launched this fund 2 years ago. So it's a very focus of TKO.
2 years ago, that does seem a bit longer than maybe your traditional sort of buyout fund. Does it take longer to raise assets, or is the timeline just tend to be different when raising for a green fund versus a typical buyout fund?
No, it's an excellent question, actually, because when we started 2 years ago, people were really cautious on this theme. And now, it's becoming the next big thing. So it's quite surprising. But when we started 2 years ago, it was difficult to get some meetings. And now, everybody is piling into the space. So there is a big difference between conviction, action, and just word. And I think now everybody will follow this trend because you have no doubt. But that's some kind of the genesis of the timeline.
What was that extra kick that you found at the end that really ramped up that interest? Is it regulation? Was it COVID? Or was there anything you can point to specifically?
I think the COVID has been an accelerator. And if you remember back in 2009, with the global financial crisis, mentality started changing. And I think, with this COVID crisis, people were mainly working from home, looking at the planet, spending more and more time there. And I think the government has been pushing very strongly. That's what you saw in Europe. And that's what we're going to see now in the US with the Biden administration. So I think it's a combination of both, the COVID and probably governments are getting stronger and stronger on this theme, which is the right thing.
Of course. Right. Of course, the other big action that TKO has taken over the past week, as Anna mentioned, is this new SPAC with Arnault and Moustier. And you, of course, have a lot of different alternative investments. What is that additional value that you get as a private equity fund and private capital from a SPAC that you wouldn't otherwise?
Yeah, I think, there is a big trend of private capital investing everywhere in Europe. And I think we are probably 10 years late if you compare to the US. And I think, private equity really took off 10 years later, infrastructure 10 years later. And I think what's happening in the SPAC now, it's been very active in the US with more than 70 billion raised last year. You've got only less than 10 SPAC in Europe. So, the trend is now migrating to Europe. And for us, it's really a tool to invest, finance private companies, help them go public and grow their businesses. And within TKO, that's what we're doing all day long. But we found the SPAC very appealing because it's enabled private company to get access to listed market. And we decided to join forces with Financière Agage, Bernard Arnault holding company, and also Jean-Pierre Mustier and Diego Di Giorgi to make sure we can align a very strong and seasoned team to help company grow.
What is that process like when you look for people to partner with? What is sort of the checklist you go through?
I think, depending on the firm, but we have a culture of partnering with people, and they should bring something different than just money, because as we all know, there is money for the time being all around the world. So it's bringing, added value, sector expertise, geographical footprints, and in this particular case, entrepreneurial drive and spirit. And obviously, Bernard Arnault has been one of the best entrepreneurs in Europe in the last decades. So partnering with them is bringing that on the table, and partnering with Jean-Pierre and Diego is bringing financial expertise on top of the drive of everybody.
Do you think there's still more opportunities left? Would you be interested in launching more SPACs?
Yeah, I think what we said when we launched this SPAC is that it would be probably a series of SPAC because it's a way to raise money and help company to grow becoming public. So we see that really as a tool, and that's really what has been done in the US by Ares or people like that. So I think it's really a tool to help company to grow. So I suspect we'll, as we announced, we'll do probably more SPACs. Yeah.
Do you think it's important that the UK and London exchanges open up and have the ability to launch SPACs there? Is that going to hold back Europe a lot by not having that ability?
Yeah, I think, UK is always very strong at getting back on track, and that's what we saw on the vaccine. And I think they decided, 3 weeks ago, to look very carefully and try to change the rules. And because obviously they've been not really benefiting from this trend, and we all see discussion, with Amsterdam and all that. But the SPACs majority has been really IPO in Paris and Amsterdam, and I think it's a good thing for London and for the UK to be part of this trend as well. Yeah.
Yeah, it will be really interesting to see if London turns into a niche market like that with more IPOs and SPACs. Antoine, thank you so much for joining us. That's Antoine Flammarion, TKO co-founder. Anna?
Danny, thank you very much. Really interesting conversation brought to us there by Bloomberg's Danny Berger. Coming up on the programme, what does tech need to outperform again? We'll put that question to the Market Live team. That's next. We'll speak to Laura Cooper. This is Bloomberg. Welcome back to the European market open, 8:51 here in London. European equity markets look fairly mixed, actually. The Xetra DAX gaining 0.4%, the London market down by 0.7%, and HSBC is the biggest losing stock on the London market, and maybe this is some read across from the sell-off that we saw in Hong Kong, because Hong Kong stocks in general were very much weaker by the close, down by around 3%, in fact, for that market, because of some stamp duty tax rises being introduced by the Hong Kong authority. Now, European stocks then pausing, with cyclical sectors, including travel and leisure and chemicals, rising the most. That's as Britain charts a course out of lockdowns and European virus cases recede. Joining us now to discuss the markets is Laura Cooper, Bloomberg Markets Live macro strategist. There seems to be a lot going on this morning, Laura. When you look at what's been developing through the Asian session and into Europe, it all looks quite complicated. We've got Asian stocks, not just the Hong Kong story, but something else spooking markets. Is it higher commodity prices weighing on sentiment there? And then when it comes to Europe, we've got really mixed performance between the likes of London and Germany. Tell us what you think is happening here.
Well, absolutely. And certainly when we came in this morning, it did look like it was going to be a risk-off day for Europe. That was taken from kind of that catalyst in Asia. We did have that stamp duty tax really hammer Chinese equities and Hong Kong equities. But I think when we look to today, it's really probably some of that catching up from that about turn in the U.S. session yesterday. We do have central bankers coming out saying there's no need for any kind of stimulus tightening anytime soon. So clearly that is feeding into this upbeat kind of narrative. But as well, we're seeing this extension of this strong rotation trade. So those tech-heavy gauges are coming under pressure as yields continued their ascent higher, whereas we are seeing those stocks geared towards that recovery trade once again kind of resuming their upward momentum.
Yeah, and talking of technology stocks, I mean, what does technology need to do as a sector to outperform once again? I mean, we saw that in the early stages, of course, of the pandemic, and now understandably not outperforming. Do you think with the messaging from the Fed as it was, that allows Treasury yields to continue to rise, and that makes it difficult maybe for tech to get back in the driving seat?
Well, certainly that does appear to be the case. The Fed is certainly not going to push back on higher yields anytime soon, because those higher yields reflect just this improving economic backdrop. They need to see a sustainable improvement there in order to kind of be able to even hint at tightening at this point. But I think really in order for tech to kind of continue to resume that leadership in the stock market, I really do think that a swift and sharp correction could actually be a healthy correction. We do see quite crowded positioning in levered tech positions. We are seeing pockets of froth and market exuberance. So if anything, if we don't see a kind of a sustained tech sell-off, that risks those vulnerable stocks, maybe contagion spelling to those kind of stocks that are more tilted towards the reopening trade. So if we do see kind of that froth come off the tech sector, that does allow for that rotation trade to take hold. And then eventually, yes, we do have tech as still a secular trend. They are still positive profit-earning companies that then they can then join the rally. But I think in the near term, we really do need to see more of a correction in tech for the broad rally to sustain.
We're just getting a red headline crossing the Bloomberg, Laura, this morning, talking about what's been going on in Hong Kong. The Hong Kong Exchange saying it wasn't consulted on the stamp duty hike. This is according to the interim CEO at the Hong Kong Exchange. We've seen the negative impact that this news around the increase in stamp duty has had on the Hong Kong Exchange share price itself, but also on the broader equity space. And of course, this then, through HSBC, seems to have some read across into London. It's one of the reasons why the London market underperforms today. Give us your thoughts on what we've seen through the Asian session and just how weak it was and how widespread that weakness was.
Well, I certainly think, it was weak, and that was evident just in the fact that Chinese outflows from the Hang Seng Index did reach an all-time high. So clearly we are seeing this flight away from Hong Kong. But this stamp duty tax was quite kind of a shock to the markets. And so I think really, the fact that we are seeing some spillover to London is not that surprising. But ultimately, the broader kind of sentiment for the day will be taken from Fed's Powell, will be taken from those ongoing signs of stimulus. We also have the Bank of England due today. So maybe markets are positioning for some dovish tones after kind of that upbeat sentiment came from them them earlier. So I think really at this point that the Asian spillover looks to be broadly contained.
Okay, thanks very much, Laura. Yeah, really interesting developments in global equities. Laura Cooper, Bloomberg Markets Live macro strategist. Thanks for joining us. That is it for the European Market Open for this Wednesday. Surveillance early edition is up next. We've got European equity markets, as we discussed there with Laura, looking to be insulated from the weakness that we saw in Asia in the main, apart from in London, where we are down by 0.6%. HSBC, one of the heavyweights that is weaker in London. This is Bloomberg.
economy is a long way from our employment and inflation goals.
Accordingly, the ECB is closely monitoring the evolution of longer-term nominal bond yields.
You never know what moves these markets. They can move, based on news, on whatever the meme of the day is.
This is Bloomberg Surveillance, early edition with Francine Lacroix.
We need to get the surveillance meme out. Welcome to Bloomberg Surveillance, the early edition on this Wednesday, 24th of February. I'm Francine Lacroix here in London, and here's what's coming up on today's program. Easy money. Jay Powell signals that rates in the U.S. are going nowhere fast. Bonds steady, stocks slide. The Fed president continues his testimony today. Buy the dip. Cathie Wood proves she's no fair weather fund manager as a cult-active ETF investor doubles down on Tesla and Bitcoin after the pullback. More from our interview with the ARC chief executive shortly. And as vaccinations drives ramp up, countries around the world lay out their plans to reopen after the coronavirus crisis. Well, we speak with the chief executive of Campari, exclusively in one of Europe's largest utility companies, Endesa, as well. Now let's get straight to our top story, market story. The closely followed founder and chief executive of ARK Investment Management has leapt into the fray after this week's pullback in tech stocks. Speaking to Bloomberg TV, Cathie Wood revealed that she's not concerned about valuations and is still bullish on Bitcoin. Let's get more with our reporter, Danny Berger. Danny, not for the faint-hearted.
Definitely not. I think it really is remarkable that she's sticking to her guns here, especially when we saw the ARK fund itself sell off pretty severely as Tesla and the other high flyers were starting to fall. But we can see from filings that she's bought about 240,000 shares worth of Tesla in 3 of her funds, to be exact. She also told Bloomberg that she still likes Bitcoin. She talked about corrections being really healthy, and that this is exactly why you have dry powder for days like those. The interview was really fascinating when she talked about this, specifically about Bitcoin. So let's take a listen to that.
We're very positive on Bitcoin. Again, very happy to see a healthy correction here. No market is straight up. Everyone should know that. Everyone should have some dry powder for days like these. And I've been saying that for a while.
And Cathie Wood does have almost, like you say, Francine, a cult-like following. People really like her funds. And I think this really just adds to the fact that she is a momentum buyer. One day of sell-offs, or in Tesla's case, almost 13% dip, isn't going to make her give up on this strategy.
So, you know, if you look at some of the moves that Cathie Wood made with her ARK funds, how much of an effect has that had in the past, and what will she change going forward?
Well, I think the fact that she has such a big following now really does mean that there's an impact on the underlying funds itself. You could say, okay, the fund goes in, it buys a bunch of Tesla, so of course Tesla is going to move to the upside. But this is just one fund. Yes, there's a lot of money backing it, but I think people do pay attention to the moves that Cathie Wood is making. Here's Tesla pre-market up more than 3%. It was up post-market as well after we learned that Cathie Wood had bought these funds, and Bitcoin also reacted. Even though we don't know for sure if Cathie Wood is even buying Bitcoin or whether she's just saying she likes it. So I think that is a pretty big testament to the following she has.
So, Danny, I was going to ask you exactly how much of an impact that's had, right? Just her words having an impact on Bitcoin and Tesla. And at the same time, ARK actually sold off pretty significantly.
It did, and you know, it has been doing well last year. It rallied about 150%. ARK has almost become the proxy for momentum stops. So it's kind of ARK, FANG is out, ARK is in, and usually investors stick with it. But we did see record outflows yesterday. So this is the daily outflow chart, more than 4 times the prior record outflow. But Francine, this chart is so remarkable. Look what happened during March. She got steady inflows. It takes a lot to rattle investors in her fund. So even though it did sell off, it was pretty surprising to see those outflows. Of course, one day a trend doesn't mean, but look at that. Look at all that green on there. I think it's really impressive how people are sticking with this ETF.
Yeah, it's just such an impressive chart. Danny, thank you so much. Danny Berger there with all the latest that we're seeing. Now, let's quickly look at the markets because we did have a couple of news on Hong Kong. So I want to show you some of the risk appetite that we're seeing in Europe. If we can get that board up, this is what I'm looking at. First of all, it's the don't fight the Fed mantra. We'll see if that holds today, as well as for other central banks. So that's definitely going to be tested today. A sell-off in Asia, of course, was triggered by Hong Kong stamp duty on stocks. And that, again, could be a shot across the bow for European risk appetite. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrits. Hi, Leanne.
Hi, Francine. Chancellor Angela Merkel is warning that Germany is facing a 3rd wave of coronavirus infections. She's urging caution as the country moves to reopen schools and businesses. Government and state officials have proposed a variety of different plans for exiting the current lockdown, leading to confusion over what's happening next. Now, Tiger Woods is awake and recovering after he was injured in a solo car crash near Los Angeles after his SUV rolled over. The golf star suffered multiple leg injuries, had to be cut free and needed surgery. The sheriff says there is no sign he was impaired by drugs and alcohol when he crashed. Aerial shots show the car on its side having suffered significant damage. The number of women on FTSE boards has risen by 50% in just 5 years, but a new report is calling for more action as men still dominate the upper echelons of UK business. The Hampton Alexander Review says there are no longer any all-male boards in the FTSE 350, but some still only have a single woman. And Senator Mitt Romney says if Donald Trump decides to go after the Republican presidential nomination in 2024, he'll win it. Romney is the only Republican who voted to convict Trump in both his impeachment trials. He says he expects a former president to continue to play a big role in the party. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, Smart Conversations on Bloomberg Early Edition. This hour, we speak exclusively to the chief executive of one of Europe's largest utility companies, Jose Bogas of Endesa, shortly after 9:30. But before that, we'll speak to the boss of one of the major players in the global spirits industry, Robert Kunze-Konzowitz of Campari Group. Two great conversations coming up. This is Bloomberg.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
The economy is a long way from our employment and inflation goals, and it is likely to take some time for substantial further progress to be achieved. Developments point to an improved outlook for later this year. You could see spending pick up pretty substantially in the second half of the year, and that would be a good thing, of course, but it could also put upward pressure on prices. We have the tools to deal with that, and we will. We don't really see how a burst of fiscal support or spending that doesn't last for many years would actually change those inflation dynamics. I really do not expect that we'll be in a situation where inflation rises to troubling levels. There's a long way to go. And monetary policy is accommodative, and it needs to continue to be accommodative. Expect us to move carefully and patiently and with a...
Good morning, everybody. If you're looking to sell short British pound right now, hold already one position. Right now I'm placing in order to sell another position. I want to sell at 141.77. So I want to open another position on British pound. So if you already hold, you follow my trades. So right now, another time to sell short British pound against United States dollar. Okay, at 141.77. Let's wait and see how long it will take us to get filled, and we'll wait until we'll get a profit on both of these positions. See you later, guys.
Adjusting rates. So I think it was comforting for investors. You can see emerging markets doing a little bit better this morning, a little bit of downward pressure on the dollar, which is what you would expect. But I don't think there were too many takeaways from the testimony yesterday, because I mean, really, I think markets were kind of set up and expecting to hear a dovish message, and that's pretty much exactly what they got.
James, are you expecting the "Don't Fight the Fed" mantra to be tested, though?
Yeah, I think as the data start to improve, you will see the market sort of testing a little bit, you know, what the timing and the pricing on Fed rates, and that could put a little bit of upward pressure on the dollar later in the year. I mean, Morgan Stanley, Ellen Zentner and her team, you know, we're forecasting very strong growth in the US this year, you know, significantly outperforming all of the other major economies, particularly in the advanced economies. And I think, you know, when you have that kind of growth differential and interest rate differentials moving at the long end of the curve in favor of the US dollar, I think it will put a little bit of, that puts some upward pressure on the dollar at some point. And, you know, the Fed will have to work quite hard, I think, to kind of control that, to make sure that the rise in yields is gradual, which is what we think will happen. We do think the rise in yields will be gradual, so that you kind of prevent a taper tantrum experience like we saw in 2013. But nonetheless, you know, the outlook for the dollar, I think, is much more balanced relative to what the consensus currently thinks, which is, you know, pretty much set up for a bear market in the dollar at the moment, and we think that's wrong.
James, I know that in your note you basically put that, of course, you're watching Jay Powell, but much more than that, you're looking at the U.S. economy. How does that, you know, what kind of template are you expecting for the U.S.? Is there a danger that it really overheats, or is it something that you think the Fed will look through almost no matter what?
Well, I mean, we're expecting the Fed to run the U.S. economy hot. You know, we think that inflation will rise above 2% later this year and pretty much stay above 2% for the next couple of years, and, you know, allowing the Fed to sort of achieve its kind of goal of, you know, around average inflation targeting. But does it run so hot to the extent that inflation expectations really run, you know, significantly higher than, say, 2.5% to 3%? I think that's unlikely. I mean, I think the Fed would probably act to prevent that. But yeah, I mean, this is going to be a high growth economy for the next couple of years. But, you know, fortunately, with the amount of labor market slack that there is, the amount of upward pressure that it puts on inflation is not going to be too concerning, I don't think, for the Fed.
James, I want to ask you about, we had a UBS note about rotation, and basically, you know, the note came out this morning, and they're warning investors to get ready for another, you know, another global equity rotation that they predict a shift from liquidity-driven market to one based on growth and earnings. They say that a regime change will be marked by a bottom in real rates and credit spread, which will signal the end of the liquidity tailwind. Now, the team at UBS also had that a small increase in real.
Okay, guys, good. We opened new position on British pound at 141.77, short position. Yeah. So right now, you guys who follow my trades, you have two positions, right? One at 140.77. This one 141.77. Okay.
Recently, where, you know, up until a few weeks ago, real yields were going down quite sharply, particularly at the front end of the curve, and inflation expectations were rising very sharply. And that is something that generally puts a lot of downward pressure on the dollar and is a great environment for emerging markets. What I think will change going forward is actually the US economy will do so well that markets will start to actually see real yields rising again. I agree with the analysts at UBS on that point. And I think that rise in real yields just makes it more complicated for the dollar to go down. It will put upward pressure on the dollar as you see real yields rise. And I think that the areas of the FX market where you'll see that most evidently is probably in the more vulnerable parts of EM. Emerging markets are lagging in terms of the vaccination rollout. Many parts of the EM world struggle for productivity growth these days and don't have very high growth potential and can't really cope that well when real yields in the US rise. So I think later in the year, as we see that unfold, it will put parts of EM under a little bit more pressure. And I think Latin America probably is the area that we would look to for that. I mean, I think there are parts of EM where really see this sort of last in, first out dynamic when it comes to the reflation trade. And I think LATAM is part of it.
So James, basically you're saying, stay maybe cautious in certain parts and stay selective. What do you choose in this kind of environment?
Yes, so we've had a bias towards Asia for quite a long time. We've been long renminbi for a while. We stay long renminbi. China is an economy which is actually doing reforms and is creating an economic opportunity for itself. So, we think that will lead to inflows and within a broadly kind of balanced dollar outlook, we think that dollar renminbi will head lower. We like the Indian rupee as well. And within the sort of high yield, high beta space, we generally favor those markets that do have slightly more solid fundamentals. So we want to take a little bit of risk by being long INR. We're long the Russian ruble, for example. We think the Turkish lira can continue to appreciate. But that's pretty much about it, really, within the high yield space. Elsewhere, particularly in LATAM, we're a little bit more cautious.
James, thanks so much. James Lord there of Morgan Stanley stays with us, and we'll talk a lot more about some of his picks in the emerging markets. Now, coming up, revenge of the old economy, our interview with Goldman Sachs' Jeff Curry about rising commodity prices and their impact on inflation. We'll also talk more with James Lord. This is Bloomberg.
like to call it the revenge of the old economy. We have not invested in old economy production capacity, in some cases 5 to 10 years. The reason why is returns in the new economy were so much better that capital got redirected towards tech.
Goldman Sachs Global Head of Commodity Research there discussing the surge in commodity prices and their impact on inflation. Now let's get back to James Lord of Morgan Stanley. James, we were talking a little bit about emerging markets, how you want to be selective and actually a little bit cautious in certain parts of those markets. What do you do with renminbi right now? So if you look at the growth, they're speeding ahead, but it could also be a very unequal growth pattern.
Yeah, so we like the renminbi. It's been a long-standing favorite of ours. You know, as I mentioned before, that within a broadly stable dollar environment that we expect, I mean, the renminbi is one that we do think will make progress against the dollar. We're targeting 625. You know, basically the Chinese economy is growing fast, and it's also doing reforms, which is something that you don't see very much of within the emerging economy space. I mean, they've been signing large free trade deals. There's the EU-China Investment Pact that they did. And when it comes to monetary policy, you know, this is a central bank that has adopted a fairly cautious approach. It's one of the few major central banks in the world that hasn't done vast quantities of quantitative easing. And so, you know, actually yields on renminbi assets are quite high, and relative to the credit risk that you're taking, we think that they offer good opportunities. And I think you're seeing that in the amount of inflows that the market's experiencing at the moment as well. So we like it.
James, given also the Chinese digital yuan experiment, is there something that the U.S. can do to actually hold on to the world reserve currency? Or is this going to be the big story of the next 10 years, that China really wants to try and make a dent in that?
So we think that the renminbi will become a greater share of global currency reserves. You know, we're expecting that maybe by the end of this decade, the renminbi will account for about 10% of global FX reserves, which is, you know, it's about 2.5% of global FX reserves at the moment. So it's a reasonably steady increase, and it will gain market share. Now, who it gains market share from is a bit unclear. I mean, we do think that, you know, Europe also wants to increase its share of global FX reserves. And so if they're successful, then perhaps the dollar will lose a little bit. But, you know, the dollar is going to remain the primary reserve currency in the global economy for a long time to come. You know, it's going to, I don't think even as China currency takes on greater share, it's not going to dislodge the dollar in terms of its dominance in the global economy. Far from it. We're just maybe shifting to a slightly more multipolar world when it comes to FX reserves, where, you know, you have a bit more share coming from perhaps Europe and China as well.
What do you do with, you know, the Brazilian real right now?
It's not a currency that we've been sort of using to express a global reflation trade. You know, like we prefer other markets. You know, we're a bit cautious on BRL now. Our forecast for dollar BRL is actually fairly flat from here. We see it around 540 by the end of the year. You know, probably there are some downside risks to that because of, you know, I think the news over the weekend about Petrobras and the appointments there raise a few question marks for investors about the commitment of the government to fiscal stability. And, you know, we think there's a risk that inflation expectations could start to rise, real yields will stay low, and that might put a little bit of downward pressure on the real. So we're a bit cautious about it. We're sort of digesting a lot of the news flow that's coming out in real time, and as a result of that, we see some downside risks there.
Thank you so much, James Lord there, Morgan Stanley Global Head of FXEM. Also, way too rested to be a new dad. Now, this is what we're looking at. The markets, first of all, the S&P 500 index futures are racing a decline, turning a little bit higher. But I think it's the mantra of don't fight the Fed that we really try and figure out today, as well as that for other central bankers, whether it will test the markets. We also saw a sell-off in Asia triggered by Hong Kong's stamp duty on stocks that could be a shot across the bow for European risk appetite. Coming up, smart conversations with the Campari chief executive. This is Bloomberg. another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Easy money. Jay Powell signals that rates in the U.S. are going nowhere fast. Bonds steady, stocks slide. The Fed president continues his testimony today. By the dip, Cathie Wood proves she's no fair-weather fund manager as a cult-active ETF investor doubles down on Tesla and Bitcoin after the pullback. More from our interview with the ARK chief executive shortly. And vaccination. As the vaccination drives ramp up, countries around the world lay out their plans to reopen after the coronavirus crisis. We speak with the chief executive of Campari and one of Europe's largest utility companies, Endesa. Well, good morning, everyone. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. So, reopening plans continue to spark optimism. In the U.S., the decline in COVID deaths is exceeding forecasts. The U.K. has also already laid out plans to slowly reopen the economy, with pubs and restaurants reopening for outdoor dining no sooner than April 12th. In Germany, Angela Merkel is under pressure to announce dates for the reopening of the hospitality sector. Now, Aperol maker Campari is one company that will likely benefit when lockdowns are over. It reported disappointing full-year results given the closure of bars and restaurants. The company, though, is one of the major players in the global spirits industry. Within its portfolio, it has well-known brands such as Aperol, Wild Turkey, and Cinzano. Well, joining us, we're delighted, is Bob Kunze-Konsovitz. He's a Campari Group Chief Executive, for an exclusive conversation. Bob, always great to speak to you. Thank you so much for joining us. I think we were looking at some of the quirky things regarding Campari, and I believe Aperol was one of the best-selling things on Amazon in the first lockdown in the UK, right after toilet paper and right after hand sanitizer.
Ahead of toilet paper.
Even better for you. How's it been faring in the last 6 months?
Well, if you look at our overall results, we're pretty happy. We had a best-in-class net sales development in the industry. We were only down 4.1%. We've taken market share across all of our markets. So we feel pretty good. And Aperol, if you exclude Italy and global travel retail, would have been up 11%. So, and last but not least, and I think this is the most important thing, is that the consumer's love for Aperol is very, very strong. It was the most discussed cocktail on the web last year. So clearly everybody's waiting for bars and pubs to open again.
So, Bob, how does that change once things reopen? Are you expecting people to just go back, like it was in 2019 and go out even more? Or will we stay in this drinking at home phase for a little bit longer? How does the pandemic actually change, first of all, the regions you want to be, but also, what kind of consumption we'll see in bars compared to at home?
Well, what we see in those markets which open even temporarily, there's a huge, huge pent-up demand by consumers for conviviality, to go out, meet friends, and have a great cocktail. We've seen this in Australia. We see this in Italy when a region goes yellow and bars open during the day. So we're pretty optimistic about that. Having said that, though, what I think is very important is that actually the lockdowns has been a big boost for cocktail culture. And most consumers have really overcome their hang-up. They've built bars at home. They have all the bottles they need. They've learned how to make cocktails, and spirits and cocktails will take more market share in terms of total alcohol in the home consumption occasion. So net to net, I think it'd be good to return to the on-premise, but I also think that we're going to continue seeing a very good trend of in-home consumption.
I mean, I think so many people, Bob, are just fed up of making their own cocktails. They can't wait for bars to be open so they can have a cocktail not mixed by themselves. When you look at a transformation deal, which I think you're looking at the moment, what region, what are you going after? What would be a good deal right now?
Look, I mean, we look at deals all the time of all sizes, constantly. Our key criteria has remained the same. Premium brands with history, authenticity, good sales in the on-premise, and a skew towards the U.S. and ideally versus Asia.
So, but this would be for, is it something local, or it would be an acquisition for distribution? Like, how much bigger do you want Campari to be? Is it diversifying or just becoming bigger?
It is becoming bigger in the markets where we are active and definitely boosting our business in the U.S., which is the largest profit pool in the industry, as well as in Asia, where we're under-indexing currently.
Where do you see, is there anything that you could actually see yourself divest of? Is there any part of what you own right now which you think won't be in the mothership 3 years from now?
Very little. There are a few local brands in South America, but I don't think there are many takers at this stage. So we feel overall pretty good about our portfolio.
When you look at Grand Marnier, is it a brand that you feel like you need to reinvigorate even more? If you look at your top 2 or 3 brands that you will focus on in the next 12 to 18 months, what are they?
Well, Grand Marnier's off-premise consumption increased by 38% last year in its main market, the U.S., and it also grew substantially in its second market, Canada. Put the two together, it's about 90% of sales. So the brand has good momentum. The brand we're going to concentrate upon this year is Sky Vodka, which we're in the process of relaunching completely behind a new positioning, incredible packaging, as well as a tweak on the liquid. And the tests, quantitative tests, were very, very strong. Obviously, the proof will be in the pudding, but we're excited to roll this out.
Bob, do you feel like you have to start a campaign to make sure that all of your employees are not anti-vaxxers?
Okay, guys, I'm going to place a stop on profit for British pound. So if it will get filled, I will get profit, and then I will sell again at the higher price, yeah? So I place stop of profit 2 pips lower at 141.75. Okay? So right now, whatever happened will be in profit. So all of you guys, you're supposed to, if you follow my trades, you're supposed to place stop on profit at 141.75. Okay?
Makers, across the world for your industry, so not only for Campari.
The legacy, on the one hand, is really this big push in-home consumption. We've really converted a lot of people, and now cocktails are really an integrated part of dinners, pre-dinner, after-dinner drinks, or even during dinner at home. That's one big one. The second one is really the acceleration in digitalization, both in terms of marketing as well as processes, and most importantly, e-commerce. We've had a big boost in e-commerce last year. 10% of our UK business is now in e-commerce. Group-wise, we're from nowhere to 2.2%. So this is significant, and I think it's going to continue growing. And we're over-indexing in that area.
Bob, I know it's a little bit early for our American viewers, but it's also 5 p.m., 5 o'clock cocktail hour somewhere in the world. So what's the secret to a good cocktail? Are you going to see more non-alcoholic cocktails pick up? Is it the ice? Are you going to have this whole infrastructure that will actually pick up? That means more sales in the next 2 to 3 years.
Well, a good cocktail is magic. You need the right glasses, you need the right brands, and the right ice, and the right garnishes. And that's special touch, which I think comes from your wrist or your finger.
But so what's the one? Do you have a go-to cocktail, or am I asking you to choose amongst your children?
It depends upon the season. Winter times, I'm very much into Boulevard Days, which is a Negroni with a twist. You take the gin out, and you put in bourbon, ideally Wild Turkey 101.
All right, Bob, thanks so much. And of course, everyone, drink responsibly. Bob Kunze-Koncewitz, the Campari Group Chief Executive Officer there. Now, more smart conversations on Bloomberg Surveillance Early Edition. Up next, we speak to the Chief Executive of one of Europe's biggest utility companies. He's Jose Bogas of Endesa, and he's coming up next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Yesterday's plunge in tech stocks offered a buy the dip opportunity for true believers. Among them, ARK's Cathie Wood. Her funds snatched up Tesla after a fourth day of selling wiped out the electric car maker's gain for the year. Bitcoin also rallied back above $50,000, thanks in part to Wood's supportive comments.
We're very positive on Bitcoin. Again, very happy to see a healthy correction here. No market is straight up. Everyone should know that. Everyone should have some dry powder for days like these. And I've been saying that for a while.
Private equity firm CVC is said to be exploring a bid for UK chemical producer Synthema. Bloomberg sources say it's made an initial approach to gauge interest in the deal. Shares in Synthema have risen nearly 50% over the past 12 months, giving it a market value of about £2 billion. It's one of the world's largest suppliers of latex for medical gloves. Synthema says it isn't in talks over an offer for the company. And Credit Suisse and UBS are relocating a number of bankers to mainland China from Hong Kong. That's to better compete for deals in the world's fastest growing economy. Having bankers in Hong Kong along a bridge between China and the West is now seen as less crucial as mainland markets do open up. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Now, the fallout from last week's electricity crisis in Texas continues to mount. The chair and the directors of the embattled state grid operator resigned this week. The Electric Reliability Council of Texas is facing calls for reform, at least 2 lawsuits for its handling of the crisis when an Arctic storm knocked out more than half of the state's power-generated capacity and plunged millions of people into darkness. Now, we have an exclusive conversation with the chief executive of one of Europe's biggest utility companies, Spain's Endesa, and this morning, Endesa has reported full-year EBITDA that slightly missed estimates, but has announced that it will increase dividend payments. Well, Endesa has been one of the most ambitious plans to develop hydrogen capacity in Spain. Jose Bogas is, of course, the chief executive, and we welcome him to Bloomberg Surveillance, the early edition. Mr. Bogas, thank you for joining us. What's your main priority and your main challenge in the next 12 months?
Good morning. Thank you very much to you. With regard to the 2020 results, I would say that we have achieved a solid operational and financial performance in a year that has been full of changes at all levels due to the impact of the pandemic. We have materialized our motto of leaving no one behind, neither as a result of the energy transition process, which we believe must be fair, nor as a result of the COVID, against which we have deployed a public responsibility plan with 25 million euros to help the people hardest hit by the pandemic and its economic consequence. Having said that, net ordinary income,
finish up, Mr. Bogas.
I'd say that net ordinary income reference figure for the dividend payment increased by 36%, up to 2,132 million euros, once deducted all the personal provision and new impairments. EBITDA, like for like, EBITDA increased by 5% year on year, reaching 4 billion. Both net ordinary income and EBITDA are above guidance.
Right. Mr. Bogas, tell me a little bit about the energy companies. If you look at renewable companies, there are at least 6 in Spain that are trying to list. Is this a crowded space? Is it going to be a little bit of a bubble forming for the industry, especially in Spain?
Well, let me say that, in Spain and all over the world, one of the biggest challenges that we have is the fight against the climate change. On that sense, we are looking, all the companies, all the countries are looking just for the complete decarbonization of the economy. And one of the pillars of this decarbonization should be and will be the shutdown of the power thermal plants and the construction and the deployment of the new renewables power plants. So that is one of the most important strategic pillars of the strategy of any utility. Even more, I would like to add that it is not only a question of the decarbonization of the electricity sector, but it's also the electrification of the economy. And again, we have here a lot to say.
So, Mr. Bogas, when you look at, for example, some of, how some of these companies could benefit, renewable companies, how many, or, what amount of projects do you think will come from the EU Recovery Fund? And how can Endesa benefit from that? Are there any large projects in which you'll be involved with thanks to the EU money?
Yeah, well, let me say that we presented the last November our strategic planning, which we gave our vision up to the year 2030. What we said is that we are going just to invest something around 25 billion euros, out of which 40%, that is 10 billion euros, will be devoted to renewables. That would mean something around between 1,000 and 1,500 megawatt per year up to the year 2030. So this is our plan. Here in Spain, the so-called National Integrated Energy and Climate Plan think about or put about 50 gigawatt in this decade. That means something around 5 gigawatt per year. So that means that we will, or our aim will be just to cover between 20 and 25% would be of this total amount.
You You have very ambitious plans to develop hydrogen activity in Spain. The problem is hydrogen needs electrolyzers, and actually none of them are made in Spain. How do you work around that problem?
Yeah, well, first of all, I would like to say that for us, hydrogen is not a competitor of the electricity. It's a complement of the electricity that will help us just to decarbonize completely the economy. Having said that, we have presented in Spain to the government of Spain, looking for the funds coming from the European Union, 23 hydrogen project, with a total amount of 2.9 billion euros of investment. I would say that there are different businesses in which this hydrogen will be involved, mainly just to the supply to the final customer, but also just to help the decarbonization of the island, which is very important for us here in Spain. What I would like to say is that today, well, this green hydrogen is very expensive in the sense is the cost is double that the one coming from the fuel. That means, in my opinion, that during the next 3 years, we will see the path of this deployment. I'm sure that at the end of this decade, we will have many business based on green hydrogen, but the way in which we are going to deploy this project, we will see how we advance in the next 3 years.
Thank you so much, Jose Bogas there, the Endesa Chief Executive Officer. Now, we're also looking at live pictures of New York. U.S. futures erasing losses. Could this be another sign of don't bet against the Fed? Well, if you're in the U.S. and you're just waking up, we bring you all of the latest market moves next. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
it is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition, and I'm Francine Lacqua here in London. Now let's get straight to our top stories, market stories, and the closely followed founder and chief executive of ARK Investment Management has leapt into the fray after this week's pullback in tech stocks. Speaking to Bloomberg, Cathie Wood revealed that she's not concerned about valuations and is still bullish on Bitcoin. Well, let's get more with our reporter, Danny Berger. Danny, she's buying at these kind of levels. So a drop, not for the faint-hearted, she says buy.
Yeah, exactly. She is no fair weather fan of the momentum trade. When Tesla was falling as much as 13% yesterday, Cathie Wood really looked at that and Bitcoin and said, you know what, both are an opportunity. She told Bloomberg that corrections are healthy, and that's exactly why you keep dry powder on hand. Now, we, of course, don't know if she bought Bitcoin, but we do know that she did go in and buy Tesla, about 240,000 shares of the company. So again, that is real commitment there. She bought it for 3 of her funds, which I should say, despite the blip yesterday because of the big tech sell-off, have done extremely well. They gained about 150% last year, and that's part of the reason why she has such a big following in the retail investor space.
So is she actually moving, the price of Bitcoin and Tesla?
Yeah, well, after she made these comments, we did see Bitcoin rise back above $50,000. At one point yesterday, it had dipped below 45,000. Tesla, as we can also see, is up pre-market. Of course, it is hard to sort of distinguish, is this just dip buyers in general? Is this perhaps some push from the ETF? Or is it from the following that Wood has, that people listen to what she says and act on it as well? It could very well be some mix of the 3, but I think if anything, it's a testament to how strong the ARK brand and Cathie Wood's brand currently is, that it does seem like she can move markets.
I mean, ARK has been doing amazing in the last 6 years, but it's also sold off pretty significantly on the shorter term. What are investors saying, Danny?
So investors at least have voted with their wallet yesterday. They pulled a record amount from the fund, about $460 million worth. That's 4 times the prior record, Francine.
Danny, thanks so much. Danny Berger there with some of the really pretty impressive moves that we've seen in technology stocks and, of course, ARK. That was a great conversation. I know we also have a crypto special live edition of our Bloomberg Live conference. That's tomorrow, so we'll bring you anything out of that. Now, Bloomberg Surveillance early edition continues in the next hour. Matt Miller joins me out of Berlin. Kaylee Lyons is in New York. Now, we'll look at the great rotation. There's, again, that note by Banu Baweja and his team members that is extremely interesting, not looking at value stocks, but actually on growth stocks. And then we had Jay Powell yesterday say, well, he wouldn't say whether there's, exuberance, whether rational or not. So that's moving markets. This is Bloomberg.
another day of risk off across the financial markets, we bring you special coverage of all the price action and implications here on Bloomberg Television.
The economy is a long way from our employment and inflation goals.
Accordingly, the ECB is closely monitoring the evolution of longer-term nominal bond yields.
You never know what moves these markets. They can move, based on news, on whatever the meme of the day is.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Well, good morning, everyone, from London, Berlin, and New York on this Wednesday, the February 24th. I'm Francine Lacqua with Matt Miller and Kaylee Lyons. A lot going on in the markets, man. I think there will be testing the result from the markets on the don't fight the Fed mantra, and that will probably spill over to a lot of other central banks. The focus also on a UBS note, looking at value stocks, and we go to the Powell testimony for a second day.
Yeah, and speaking of UBS, Hong Kong is increasing its stamp duty, and that drove investors out of the HKEX and the Hang Seng. 3% was the Hang Seng close, the drop there, so pretty significant. At the same time, Hong Kong is going to spend more to help residents bounce back from the pandemic, and UBS and Credit Suisse are moving from Hong Kong into the mainland to really deepen their commitment to China. So I think you've got a couple of stories there that could go in either direction. Maybe investors are going to buy the dip tomorrow.
Yeah, and I think when you look at some of the stamp duty that we saw in Hong Kong, it's definitely having an impact on risk value in Europe. Now, some breaking news also out of Washington. President Joe Biden ordering a government review of U.S. supply chains and seeking to end the country's reliance on China and other adversaries for crucial goods. This may also go back to the semiconductor story. I think delays there are extended to 18 months. Kaylee, what are you seeing on the markets today?
Well, I am paying close attention to Hong Kong, as you and Matt both mentioned. The Hang Seng Index down 3% in the Asian session off that stamp duty increase, the first since 1993. But that negative risk sentiment is not bleeding into the U.S. session, at least at this point. With 4.5 hours to go until the U.S. Open, we are seeing futures inching higher, including on the NASDAQ 100, up about 0.3% after that dramatic buy the dip action we saw yesterday. At its lows, the NASDAQ 100 was down by 3.5%. It only closed about 0.2% lower. Part of that's buy the dip. Part of that is Jay Powell saying we aren't getting rid of our support anytime soon. He also didn't do anything to talk down the selling in the bond market. He said, if anything, the bond market is sending a signal of confidence about the recovery, and we are seeing yields continuing to climb higher to the tune of about 3 basis points on the 30-year Treasury note, now sitting above 2.2%. And have to talk about Bitcoin. Investors paying attention to anything the crypto faithful say about the price of that asset. And Cathie Wood saying she's still positive on Bitcoin, thinks the correction we saw over the last 2 days was healthy, really aiding investor sentiment. That up 6% to above $50,000 once again. And tied to Bitcoin, as we know, is Tesla, another Cathie Wood favorite. That, of course, a company that made a $1.5 billion investment in Bitcoin. And after a 12% decline over the last 4 days, Tesla up 4% in pre-market trading. And I would just point to 2 other stocks closely tied to the price movement in Bitcoin, Matt. Marathon Patent and Riot Blockchain up 17 and 15% respectively in pre-market trading. Definitely some big moves going on, Matt.
Yeah, and don't forget Square, right? I mean, Jack Dorsey's Square has bought another $170 million worth of Bitcoin, just over 3,300 coins. So we'll watch that. I've got a chart here that's kind of a tribute to Francine and John Farrow, two of our most devout ECB watchers. This is really fascinating because I still think of Christine Lagarde as the new ECB chief, and yet she has added more to the central bank's balance sheet than Mario Draghi. In her 15-month stay at the ECB so far, she's added more than $2.9 trillion to the balance sheet, 2.4 trillion euros, just a ton of money. Over his 8 years there, Mario Draghi only added 2.35 trillion euros to the balance sheet. So she has really come out of the gates running and just boosting this balance sheet to over 7 trillion. Francine?
I love that chart. And you know what, Matt? I also love when you look at the, how it started, how it's going, and actually what she was saying at the beginning of her tenure and what she's saying now in terms of looking also at yields. Now, the Fed chair, Jay Powell, signaling the central bank is not going to pull back on its support for the economy anytime soon. Here's Powell in his own words.
The economy is a long way from our employment and inflation goals, and it is likely to take some time for substantial further progress to be achieved. Developments point to an improved outlook for later this year. You could see spending pick up pretty substantially in the second half of the year, and that would be a good thing, of course, but it could also put upward pressure on prices. We have the tools to deal with that, and we will. We don't really see how a burst of fiscal support or spending that doesn't last for many years would actually change those inflation dynamics. I really do not expect that we'll be in a situation where inflation rises to troubling levels. There's a long way to go. And monetary policy is accommodative, and it needs to continue to be accommodative. Expect us to move carefully and patiently and with a lot of advance warning.
Well, joining us this morning to talk Powell, to talk markets, is James Bevan, Chief Investment Officer at CCLA Investment Management. James, if you look at financing conditions, first of all, good morning to you on this Wednesday. If you look at financial conditions, if they're going to be less favorable, what does it mean for markets?
Well, at the moment, it is very clear that central banks have their foot hard on the accelerator. And I would suspect that, therefore, we will see continued rampant growth of money supply of all the bubbles that one can observe. Money supply is far and away the most extraordinary. I think that we will, however, see Federal Reserve Bank action to contain bond yields. I would estimate that the fair value 10-year yield is actually around 2.5%. in current market conditions, rather than just under 1.5%. And I would liken this current period to the post-war period when the US government and Federal Reserve put a lid on 10-year bond yields and allowed inflation to rise, therefore diminishing the scale of US government debt that had, of course, built in the war years. So for me, that makes bonds almost uninvestable, yields still way too low. It means that we should continue to focus on quality companies. Yeah. The big question at the moment is the extent to which we should also focus on cyclicals.
Yeah, so there was a great UBS note out that also, I think, at the margins probably impacted the markets. And they say, look, focus on value stocks or focus on growth stocks over value. Do you agree?
Well, I think that the expectation that we should stick with a single style in a fast-moving market is probably incorrect. And what we have to do is to focus on the quality of the individual assets in focus. So I would observe that there are some great quality banks in the global market, but you have to be very picky. I would be buying, for example, JP Morgan and Bank of America, and I would still not be prepared to touch the apparently very cheap European banks. I would say, however, that there are Asian banks that people should look at, like HDFC, and indeed HSBC now coming back with a business strategy that looks capable of securing long-term growth. Equally in technology, I know that many people say, do you know that sector's overcooked? I look at the 3-year rolling free cash flow prospect for Microsoft, and there I see a share which I think is structurally weak and therefore should go a lot stronger.
I want to just show you a chart. You mentioned cyclicals, and we have a chart of European cyclicals' real outperformance. They had been tracking U.S. bond yields, but they have jumped. The chart is 60.92 in the terminal. Hillary put it together for us this morning. And I wonder, has it jumped too much? Are you going to keep buying this, James?
Matt, what I find interesting about this chart is that if you were to overlay the history of the Purchasing Managers Index, we're talking about a correlation with a PMI of in excess of 70, discounting, therefore, real economic growth in Europe of close to 5 percentage points. Now, frankly, notwithstanding the fact that Madame Lagarde is pushing as hard as she possibly can, I don't see the Eurozone economy being able to achieve that level of growth. So I certainly think the cyclicals are overcooked. The non-financial cyclicals are overcooked in Europe. Far better, I think, within Europe to focus on the quality luxury goods companies, the LVMHs of the world, the Kerings of the world, because those are the companies that on a 3-year view, I think, can still positively surprise.
Is this a play on vaccinations and getting back out there? I noticed that a little bit earlier in a report out, the EU is going to boost its vaccinations and could get to 75% by August.
Oh, I think it's absolutely critical that we have the vaccination rollout, and absolutely critical that the vaccination program is seen to be working. Then the cash that has built within economies can be unleashed. However, whereas there is huge household wealth recognized in the US, I think Europe is a slightly different kettle of fish. Germany didn't have that more significant cutback, and therefore I don't think that they will have a particular surge. With Italy and Spain, I certainly expect a short-term surge, but I don't believe that the long-term accretion of real wealth in those economies will allow growth to continue at that sort of pace for any time beyond the end of this year. So I would view Italy and Spain as very tactical choices, and Germany, despite the fact that it is going to be a laggard in terms of recuperation, and much more interesting in terms of long-term growth qualities. So I'm looking at companies like Schneider Electric.
James, I want to go back to something you said earlier about bonds being basically uninvestable at this point. Then what do you do with a 60-40 portfolio? What do you put in the 40 part? How do you hedge?
Well, I would translate a 60-40 portfolio into an assumption on the sort of volatility that the investor can tolerate. And I think that we can deliver very similar volatility to a 60-40 traditional portfolio with a blend of equities and real assets such as infrastructure and some of the property plays. So, for example, after a very difficult COVID-19 episode, I think student accommodation and doctor surgeries are back in the frame as very interesting long-term investments where cash flows are typically linked to inflation, therefore providing inflation proofing as well as strong current free cash flow.
James, what you mean, classes resume in person? James Bevan with a bold call from CCLA Investment Management. We'll get back to James and look at what the post-COVID world looks like. Coming up later this hour, Christian Muller-Gleesman. He's Goldman Sachs Managing Director and Portfolio Strategy and Asset Allocation. And then a little bit later today, also the former Federal Reserve Vice Chair, Alan Blinder. That's at 10 a.m. in New York, 3 p.m. in London. They'll talk about financial conditions, and of course, they'll talk about treasuries. This is Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
At Standard Chartered, we believe money can be a force for good. Which is why we've committed $75 billion to funding sustainable projects in parts of the world that need it most. Because progress doesn't have to cost our planet. Standard Chartered, here for good.
This is what community looks like. Caring for each other. Protecting each other. And as the COVID vaccine rolls out, we'll be ready to administer it.
E-Class, Motor Trend's 2021 Car of the Year.
We bought a lot of Tesla today across any strategy that holds Tesla. And we will be publishing in a few weeks a report updating our thoughts about Tesla, our excitement about the potential of a ride-hailing service as a bridge to an autonomous service.
Kathy Wood of ARK Invest talking about Tesla on Bloomberg Radio yesterday, buying the dip we had seen in the shares down 13% or so over 4 sessions, but rebounding this morning. And that buy the dip mentality really evident in the broader tech sector as well. At the lows yesterday, the NASDAQ 100 was down 3.5%, but it closed only 0.2% higher. Granted, that was still the 6th down day in a row, the longest losing streak since August of 2019, but we are seeing the gains continuing in the futures session this morning. The question is, are higher yields still going to be a problem for tech and growth stocks or not? Because they are still sitting around the highest level in a year. The 10-year yield up 27 basis points just over the month of February thus far. And as a result, value has been outperforming growth. The S&P 500 Value Index up more than 7% over the course of the month of February. The growth counterpart, for its part, only up by about 1.8%. That is the widest margin of outperformance of value relative to growth in 2 decades, since going all the way back to December of the year 2000. The question now, Francine, is whether or not this dynamic is going to continue going forward in a, in theory, higher yield environment, Francine.
Yeah, Kaylee, it's a good question for James Bevan from CCLA Investment Management. But first, James, what exactly is moving technology stocks? So, Kathy Wood comes on, she talks. Is that really what's moving Tesla and Bitcoin?
Well, I would say that there is certainly a speculative mania, and the combined challenge for the cryptocurrencies and companies like Tesla is, what are they actually able to do to justify their long-term valuations? Now, in the case of Tesla, I would observe the competition that is coming towards them from companies like BMW that have made it abundantly clear that they are throwing down the gauntlet for the electric vehicle market share. And indeed, if we add up the aspirations of all of the electric vehicle manufacturers, they thoroughly exceed the anticipated future scale of the industry writ large. So I think that Tesla is definitely going to be challenged. But at least I can see that they make cars, and at least I can see that they have energy systems, and ultimately there will be cash flow. In contrast with cryptocurrencies, I see absolutely no floor to value. And therefore, I would observe that what we are seeing as price action is rampant speculation with no foundation in real value whatsoever.
So, James, what do you buy? Is there anything that you own in technology stocks that you want to load up on? And how do you play the semiconductor story?
Oh, I absolutely see great value in some parts of the technology. I would be buying more Alphabet at current levels, certainly more Microsoft at current levels. And I look at the semis world and I see a significant long-term chip shortage. I am a holder and would be a buyer on weakness of Taiwan Semiconductor as a company that absolutely demonstrates that it has the wherewithal, the commitment and the capacity to deliver outstanding long-term shareholder value growth.
You know what? I want to tag on Fran's question there, James, because I know you're a conservative British man, but doesn't it give you FOMO to see Bitcoin going from like 600 to 60,000? I mean, when you see, for example, a SPAC like CCIV getting Lucid backed into it at a valuation of 24 billion, don't you look at Tesla even at 500 billion and say, I want a piece of that? High risk, high reward.
No, absolutely not, Matt. If you're going to talk about conservative British attitudes, let's get back to the South Sea bubble, one of the great bubbles of all time, where people had no idea what it was about, but they saw it going up. Because it was going up, they wanted to be part of the story. I think that's exactly where we are with Bitcoin today. And in years to come, we will look back at Bitcoin as the poster child of speculation on the back of this rampant money supply. Now, that doesn't mean that I don't believe in digital currencies, but I do think that digital currencies will end up being controlled and issued by central banks as part of their strategy. So the big news for me will be when the Fed fully endorses the shift to digital currency. When that happens, I think Bitcoin's days are over.
James, thank you so much. I couldn't tell from Matt's voice whether that was a compliment or not, a conservative British man. James Bevan, Chief Investment Officer at CCLA Investment
Definitely
Management.
a compliment.
Coming up later, of course, later in the program, Puma warning about a slow start to the year. We'll be speaking to the Chief Executive, Bjorn Gulden. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
The Harry's razor is not the same. Our razors have 5 German-engineered blades designed to stay sharp, so you can enjoy lasting comfort. And we never upcharge you for high quality. Harry's, available in store and at harrys.com.
In boxing or any other business, one day, you're gonna take a hit you didn't see coming. Do you stay down, or do you get up?
And this fight is a long way from over. Leonard is coming back.
So you're a small business, or a big one. You were thriving. But then, time to think, plan, pivot. How do you bounce back? You don't. You bounce forward with serious and reliable internet, powered by the largest gig speed network in America. But is it secure? Sure, it's secure. And even if the power goes down, your connection doesn't. So how do I do this? You don't do this. We do this together. Bounce forward with Comcast Business.
All the things, all around you, where you learn, work, and fly. We help make them healthier. We are the people of ABM. For more than 100...
All of you guys who follow this trade, we need to put your stop on profit further to 141.67. We'll have nice 10 pips profit. Okay? Just right here. Okay, if you've done it, well done. If not, please do this right now. Okay?
It's only human to care for those we love and also help light their way. It's why last year Chevron invested billions of dollars to bring affordable, reliable, ever cleaner energy to America.
At Empower Retirement, we help you open doors that get you ready for everything that lies ahead. Because your financial wellness is what matters most. Behind every door is an opportunity to save for life's moments.
So proud of you.
These are your goals, and it's time to help get you there. We've been opening doors for more than 12 million customers across America as they save for the future they want. We are Empower Retirement, and we're ready to open some doors for you.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kaylee Lines in New York. Let's get the first word news for you from the Bloomberg terminal. The House will vote Friday on President Biden's $1.9 trillion stimulus plan. That's according to Majority Leader Steny Hoyer. The president expects the package to pass by a narrow margin. The big question is the fate of the $15 an hour minimum wage. 2 Democratic senators actually oppose it. Republican Senator Mitt Romney says if Donald Trump decides to go after the nomination in 2024, he will win it. Romney is the only Republican who voted to convict Trump in both his impeachment trials. He says he expects the former president to continue to play a big role in the party. And Hong Kong introduced its first stamp duty tax increase on stock trades since 1993. That led to a broad market sell-off. Shares of the Hong Kong Stock Exchange fell almost 9%. It was their biggest decline since 2015. Mainland-based funds sold a record $2.6 billion worth of Hong Kong stocks. Finally, golfing legend Tiger Woods was described as awake and recovering after a single car accident outside of Los Angeles. One doctor said he had significant orthopedic injuries. Woods rolled his SUV in a steep terrain and had to be extricated from the vehicle with the jaws of life. Police say there are indications he was driving at a relatively higher speed than normal. And I don't know how much either one of you follows golf, but Tiger Woods is an absolute legend, not only for winning 5 Masters, which I think is the greatest sporting event in the world, but really for making golf a cool sport, for bringing it to the masses and making a lot of people previously who wouldn't have played want to get out on the links.
Yeah, and he inspired, of course, a lot of young people. I think he turned pro in 1996 and has been really, by all accounts, one of the most successful golfers of all time. It was also a quite colorful, I would say, life outside of tournaments. But I have to say those pictures were absolutely horrific, and we can only wish him well.
Yeah, absolutely, Francine. I mean, the statement out of the UCLA Medical Center, the injuries and the surgeries required that they described didn't sound good. And of course, he already was recovering from a back surgery, Matt. So the question is how long this recovery from these particular injuries will be and at what point he may be able to actually return to the game of golf.
Yeah, it's a huge bummer because I was hoping to see him try for a 6th Masters. It's always great to see Tiger Woods in that green jacket, and it looks like this could be at least a serious pause to his golfing career. Fran?
Yeah, just terrible. And to see, some of the greats actually in these accidents, a little bit like Schumacher all those years ago, it just, puts everything into perspective. Coming up next, Christian Muller-Gleesman, the Goldman Sachs Managing Director in Portfolio Strategy, Asset Allocation. We'll talk to him about Powell. We'll talk to him about rotation markets and treasuries. This is Bloomberg.
Here's AJ.
When are you going back into the Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Good morning, everyone. Bloomberg Surveillance, the early edition, and here's some of our top stories. Easy money. Jay Powell signals that rates in the U.S. are going nowhere fast. Bonds steady, stocks slide. The Fed president continues his testimony today. Buy the dip. Cathie Wood proves she's no fair weather fund manager as the cult active ETF investor doubles down on Tesla and Bitcoin after the pullback. More from our interview with the ART chief executive shortly. And vaccination drives ramp up while countries around the world lay out their plans to reopen after the coronavirus crisis. We speak to the chief executive of Puma very, very shortly. So live from London, Berlin, and New York, I'm Francine Lackwell with Matt Miller and Kaylee Lyons. A lot going on in the markets. Of course, it's all about the Fed, whether you're taking on the Fed or not. We also have Andrew Bailey in front of testimony lawmakers a little bit later on, and the rotation that we're seeing in that UBS note, that could spell what's coming in the next couple of months. Kaylee, what are you watching in the markets?
I'm watching a lot of green on my screen, Francine. Jay Powell saying we're not going anywhere anytime soon, and that he's not overly worried about asset prices, seems to be giving a nice lift to risk sentiment, both in the European and U.S. future session. The stock 600 higher by about 0.5%. NASDAQ futures pointing higher by about 0.3 after it just lost about 0.2% in yesterday's session. A big buy the dip rebound taking shape. We will see how long that can last today. If investors do decide to continue looking through higher yields, the 10-year yield, I should note, moving up about 2 basis points, still sitting around 1.36%. The commodity complex losing a little bit of steam, though Brent crude is still holding above $65 a barrel, up about 0.6. WTI holding on to some gains too. We will see how inventories data out of the U.S. at 10:30 a.m. Eastern time may or may not change that narrative. But forget about oil, forget about old energy. Let's talk green energy. That is the theme for my stock movers this morning, starting with Tesla. Francine, you were just talking about Cathie Wood buying the dip. That is giving investors some confidence after 4 consecutive days of losses. Tesla up about 4% in pre-market trading, as is Churchill Capital, the SPAC that is taking EV maker Lucid Motors public for a $24 billion valuation. The stock fell 40% yesterday on that news, but a nice rebound taking shape this morning. And then sticking with that clean energy space, 2 hydrogen fuel cell makers, Fuel Cell Energy and Plug Power, each up about 4%. JP Morgan out with a note this morning, Matt, about the hydrogen revolution picking up steam, and that is picking up some steam in these stocks this morning, Matt.
All right, very interesting. I always root for the hydrogen revolution because that's what backs the new Grenadier, which is like the new version of the Range Rover Defender. I want to just talk quickly about what's pushing yields higher. Yesterday, Jay Powell said it's not inflation, it's expectations for economic growth and optimism in the economy. I think it might be inflation. Here's a chart of the U.S. core PCE price index in blue. You can see it's clearly rising. And maybe more important, in white, inflation expectations. Even for the Fed, this may be more important. You can see these are the 5-year break-evens just shooting higher. So it looks like the market certainly is expecting inflation to pick up substantially, and I think that is what's behind the rise in yields. Fran?
What a cool chart, inflation expectations going forward. Joining us now is Christian Muller-Gleesman. He's Managing Director and Portfolio Strategy, Asset Allocation at Goldman Sachs. Christian, thank you for joining us. I mean, it's very clear when you listen to Powell that, first of all, he was quite bullish, certainly. Well, he managed to say that there was no exuberance in the markets, better be unwanted exuberance or not. So what do you make of his testimony overall? Is it supportive for stocks?
Oh, it's definitely supportive. I think the big problem is we entered this year with quite a lot of optimism, no? Like risk appetite based on our metrics, sentiment has gotten very bullish. But I think the problem is you kind of had last year like a different regime with regards to inflation. Last year was all about fading deflation risk. And I think since the beginning of the year, the market is now getting to a point where it needs to price what the new inflation kind of regime will be. And with the break-evens where they are, and as you were showing earlier with like core PCE, and in particular more leading indicators like ISM prices paid and other things pointing towards a significant acceleration of inflation, you're kind of shifting from pricing out deflation, which is really good for equities, which is okay for bonds, which is pretty much good for most assets. You're shifting now towards pricing a bit of an inflation overshoot, at least a temporary one for like a few months. And that's not so easy to digest for markets.
But Christian, given where we are we going to see lower overall returns in markets in the next 8 to 9 months?
Yeah, I mean, like, as we discussed before, I think everything is a bit expensive, no? And valuations have benefited a lot from this very low level of rates. And I think the key question we have to ask ourselves now, as Matt was saying earlier, is the market repricing longer dated bond yields on a more sustained basis? If that's the case, if the market really reprices the distribution of inflation, not just for a few months, but possibly for the rest of the cycle, I think the drag from bond yields on returns is going to get bigger. And that's the key question from here. Is the market really having some type of risk premium that starts to get embedded into the bond market? Because you have to consider the last cycle, inflation was always anchored and generally skewed to the downside. And when you started out of the global financial crisis, the recovery, no one was worried about inflation. Actually, for the first few years, it was all about worry about deflation, considering all the damage you've done to the system. Whereas this cycle is starting much earlier, with markets being worried about inflation and pricing inflation overshoot. So if that continues, there's a definite chance that you have a much bigger drag from rising bond yields on valuation.
Christian, we're looking at a board of bond yields. The color is red, even though the yields are rising. I keep trying to get them to fix that, but I guess they color it based on the price moves. How high do you think yields are going to rise? Because UBS put out a note saying when the bond sell-off bottoms out, you're going to see a rotation shift back into growth.
Yeah, I think this is the kind of big question now. We do have a cyclical and a structural story. I think the cyclical story is well underway and to some extent priced. And that's a story where you have base effects in the inflation in the next few months, which will push up core PCE, core CPI. And by the end of the year, a lot of these effects are starting to fade. And you go back to a structurally low-inflation, anchored inflation environment. And with that, the upside to bond yields is limited. No, and you could argue that where we are right now is having a bit more upside. I think we have a target of 1.5 for 10-year treasuries at the end of the year. But you could argue that the recent moves are actually quite a bit ahead of that cyclical story. But then there is this structural story, which the market is worried about, which is that inflation becomes unanchored. And related to that a lot is what's happening in commodities. I think you've seen an unprecedented amount of deficits across the commodity markets and very strong performance. And there's a concern that maybe much earlier than normal in the cycle, commodities will do really, really well and keep the inflation levels maybe a bit higher, coupled with some of the policies which were mentioned earlier on the fiscal side, on minimum wages, and all of these things, they're worrying investors right now. And that might mean that bond yields could easily overshoot like just the cyclical story because of these structural concerns.
Well, in the cyclicals, Jeff Curry was on with Tom and John yesterday and said, this is the revenge of the old economy. One of the big problems is not enough money was invested in the old economy when we were all stoked about growth. But now it's going back in there, plus ESG. Commodities haven't all rallied, though. If we're looking at inflation, the possibility of inflation, and we see value up, we see commodities up, why don't we see tips and gold as good investments? I mean, historically, gold is the great inflation hedge, isn't it?
Yeah, it's a really good question. I think you have all these kind of real commodities, which are used in the economy, like oil and copper. Copper has a very strong story with the Green New Deal. Oil has a very strong story with the reopening. And they have a genuine demand driver, which is linked to the economy. Whereas gold has a demand driver, which is linked to risk aversion, which is linked to real yields. As you were saying, the tips market and gold are very similar, and safe haven flows. And by virtue of risk appetite being so strong, I think gold at the margin has suffered quite a bit from outflows. And I think what you have to consider as well is that real yields are still incredibly low and very very negative, and they just look very poor asymmetry from here. Because if things are getting better, there's a real chance that real yields continue to creep higher, especially if we get a bit of an overshoot, as we said. So my sense is that there's a real reassessment of the kind of negative asymmetry gold might have if everything goes well. Eventually, however, there's like three inflation phases to me. The first one is fading deflation. The second one is pricing inflation overshoot, which we're in. And then the third one is the actual inflation coming through. And if we look in history, like in the 70s and 80s, where you had these really high and rising inflation regimes, gold actually did really well. So eventually there is a place for gold if inflation actually does pick up on a realized basis. But right now it's all about pricing expectations, rather than actual realized inflation. So there's a case for gold coming back, I think, as well. But currently it doesn't fit perfectly for this reflation story.
Christian, we need like 3 hours with you. So next time, let's book it in, cancel all of your meetings so that we can really look more at the markets. Christian Muller-Gleesman there, Managing Director of Portfolio Strategy and Asset Allocation at Goldman Sachs. Now, coming up next, we speak to the Puma Chief Executive, Bjorn Golden. That's working from home, the new thing. Do you just wear slacks and trainers? We'll ask the Puma Chief Executive what that means for sales. This is Bloomberg.
Nuestro país, igual que los demás países del mundo, no está preparado para esta pandemia. Más aún, los más afectados son los países de desarrollo como el nuestro, ¿no?
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacroix in London and Kelly Lines in New York. Now, Lucid Motors has shied away from comparisons to market leader Tesla, but its public listing positions it to compete for a slice of what's expected to become a rapidly growing market for luxury electric vehicles. The CEO of Lucid, Peter Rawlinson, spoke with Bloomberg's Ed Ludlow about a meeting with legendary former Ford CEO Alan Mulally.
To market with Model S 10 years ago. I think a lot of slack was cut then because, you know, the electric car was such a fun experience. People forgave the build quality issues. The market is not going to be forgiven now. This is a very different world. We have to get things right. And the impact of COVID is not to be underestimated here, Ed. So, you know, we're chasing down a number of suppliers from around the world. We have 250 suppliers, 3,000 parts, and that whole infrastructure, logistic operation has been affected by COVID. So that's had a big impact of just pushing it out a little bit into the second half.
Has the global semiconductor shortage had any impact and caused this delay in production?
It hasn't for us because we've had some very savvy purchasers in our purchasing teams who actually preempted this and have negotiated supply agreements which have really mitigated that risk. But I recognize it's affecting some of the automakers, notably Porsche with their announcement very recently.
That was a Lucid Chief Executive Peter Rawlinson speaking with Bloomberg's Ed Ludlow. I know you were way out front on this, Matt, because you know you said yesterday we need to look at Lucid, and there you go. We did, and we also got the interview.
I'm very glad, and I just want to point out that great interview by Ed Ludlow, and he had been talking with Peter about driving an electric car, the Lucid Air, with Mullally, which is why I wanted to mention that meeting. It's such an important figure in the plane and auto industry. I want to talk, though, right now about Puma. It is warning about a slow start to the year. It's an athletic gear maker, of course. It forecasts moderate sales growth in 2021 as the pandemic continues to sap demand and lockdowns keep stores closed. Joining us from Herzogenaurach is Bjorn Gulden, the CEO of Puma. Bjorn, I would think that, you know, with an increase in the vaccine rollout expected for the EU, and it's going well in the UK and the US, more people would want to get out on the what do you call it, football pitch, or more people would want to get out on their Ducati motorcycles. You make boots for them as well. Why don't you expect a bigger pickup in demand?
Well, I think the demand is there, but if certain markets have a lockdown and the stores is closed, then it's difficult to look at the growth, right? We had a great third and fourth quarter despite restrictions. The outlook for the year was great, but then Europe went into a lockdown. And it's obviously that if you're not allowed to play soccer and you're not allowed to gather in social gatherings and the stores are closed, then it's difficult to be bullish for the short-term future. But I agree with you, as soon as the restrictions are gone and more people get vaccinated, the weather gets warmer, I think both Puma and the industry in general has a great outlook.
What's the most important driver to growth for you? I mean, I remember a time in London when literally everybody was walking around in Puma driver's shoes. Obviously, it must be important to sign a contract with a big soccer team. What drives growth the most?
Well, I think in general now, I think sports and sports fashion are popular all over the world, you know, from the US to Europe to China. And what is important is to stay relevant, so that you have the right partners, like we have now with Dua Lipa on the female side and with Neymar on the male side. You need to have the right product. And of course, we need to get this pandemic away so that people can do what they want to do. And we can do sports and have fun again. I think we all look forward to that.
But Bjorn Gulden, I mean, we're all from home. I know we're not wearing much shoes, but we're all in this leisure wear. I mean, you know, most of our viewers haven't worn heels if they're women in like 10 months. So do you need to just get better online so that people buy the things, but by not going into the store?
Yeah, I mean, first of all, we don't sell heels, so I'm glad that you're not wearing heels. You should you should wear sports shoes. And you are right. I mean, leisure wear has exploded, and those markets who are open are also doing well in footwear. The problem is, of course, that you can't shift all your sales from brick and mortar to online. And, you know, we grew 60% online last year. I think we will see the same rate this year. But of course, we are dependent on that real stores are open and that sports is allowed. I mean, we're sitting in Germany right now when almost no sports is allowed. I can't even play golf or tennis. And of course, it's difficult to sell, your gear if you're not allowed to use it. Having said that, I'm very, very positive for the midterm outlook. I just don't know if Q1, I don't know if you think you're sitting in the UK. I think your Prime Minister said yesterday that the retailers will open first on April 12th. I mean, it will be bumpy in the beginning of the year, and then I think you will see during Q2 improvement, and then I think we will have a good second half as we had this year.
But any regrets on not focusing more on this direct-to-consumer strategy, or are you going for the longer-term play of actually going back to business the way it was in 2019?
Well, I think there is a limit to how quickly you can expand your D2C strategy, and I actually believe in a multi-branded environment, and I want to be a partner for the retailers. So I think it's a combination. We're looking at 30% D2C and 70% wholesale business through our retail partners, and I think that's a sound balance. Also, to grow very quickly, 60% on your e-com, you need to have the logistics in place, and nothing is worse than offering something and then your service is bad. So you have to be careful how quickly you grow and balance it. We feel very good about the sector and also for Puma midterm. We just need to get through, the next couple of months, and then I think things will look different.
All right, thank you so much for joining us. Björn Gulden, the Chief Executive of Puma. It's actually amazing, Matt, when you look at, I guess, our peers and what everyone's buying. It really changes. One thing that we need to get the Chief Executive of Puma back on is just to see who his biggest rival is, right? Is it Adidas? Is it Nike? Like, who do they really want to go after?
Well, Adidas is also based in Herzogenaurach, so they're in the same town. And of course, Adidas was founded by Adolf Dassler. He made the first removable cleats for the 1954 World Cup. His brother, Rudolf Dassler, then founded Puma. So they are kind of natural rivals.
Yeah, nothing like a sibling rivalry. I have that at home. I can attest to it. Coming up later in the program, Marriott International Chief Executive Anthony Capuano. That's at 3 p.m. in New York, 8 p.m. in London. It'll be a really good conversation, of course, on hotel reopenings and travel. This is Bloomberg.
let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance, the early edition. Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Tom Keene, co-anchor of Bloomberg Surveillance Simulcast, now joins us. Tom, we were talking about, I think, Roman and mythology in the Greek time, including Cleopatra. So save me. What do you have coming up on the show?
Well, we got coming up is some really interesting market moves, including, as you're well aware, the sterling advance becomes more sterling ever more. Let me show a chart here, Francine, which goes to the long term, not the South Sea bubble of James Bevan and Bitcoin, but the long-term 50-year chart of an advancing sterling versus a weaker Swiss franc. And it really puts it in perspective that the 87% depreciation of pound sterling over half a century is really quite remarkable. We've gone from 10 francs per pound sterling to just over 1.28 francs. Francine, sometimes a long view can be a little painful.
Yeah, how much focus? I mean, I know you did a great interview yesterday with Jeffrey Curry that, led to gold comments, but how much are you focused actually on Bitcoin?
Well, on Bitcoin, to me, it's a separate thing. I think it's not a secret. Matt Miller and I just flat out disagree on this. I'm in the camp with a lot of other critics that we see. And of course, Secretary Yellen her comments were extremely important a few days ago. This is one of the themes we're going to address with Rebecca Patterson of Bridgewater. She has written on Bitcoin. She's very good on foreign exchange as well. And we'll also talk to the congressman from Wisconsin, Mr. Stiles.
I think Matt, called James Bevan an old school British conservative man because he didn't like Bitcoin. I wonder what you'd call Tom Keene.
I wonder if you'd rather be right or rich. If Tom Keene had gotten on the Bitcoin bandwagon when I told him about it at 600, he would be sitting on a beach.
Yeah, more Bloomberg Surveillance simulcast this time is coming up shortly. This is Bloomberg.
are you running around the world saving the world from hunger? Why are you doing that?
I want to live in a world that I kind of believe everybody's doing as well as my daughters.
We can see a situation where the U.S. economy grows faster than the Chinese economy in 2021.
As you see the economy further reopening, as you see a shift back towards services spending and a normalization in activity, a lot of those jobs can come back quickly.
We're creating really tight markets, whether you're talking metals, energy, agriculture.
We're reaching this critical shortage of durable goods in the U.S. and elsewhere.
What is the outlier event we could see in 2021? It's a blowout year for the economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg Television. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equity futures bouncing back. The S&P 500 up 5 points. We advance a little more than 1/10% this Wednesday morning. It's day 2 for Chairman Powell, Tom Keene, and you get a sprinkle of Vice Chair Clarida and a little bit of Governor Brainerd as well.
Yeah, Clarida is who I'm going to pay attention to, and of course Brainerd really vetted as the salvation of the central bank for liberals and Democrats. John, what I would notice is the VIX yesterday going from a 27 of angstful fear and right now down 4 big figures, 23.15. And I'm going to say all of that came from the reassurance of the chairman.
Tom, when you maintain the same message as everything around you changes, you're sending a message. And as this recovery really starts to take hold, this message is going to sound a whole lot more dovish.
I got to be honest, and I know we're going to beat on this for the next 3 hours on radio and TV. It's real simple, John. Dollar weakness, we're right at the cusp of that range. On DXY, we had a little bit of an 89 handle going on here at 90.1 right now on DXY. I'm watching weak dollar as a key tea leaf.
I'm looking at yields. Yields high, Lisa. Curve steeper.
Yeah, the key question as you raised is sort of if he's maintaining the same message to Jay Powell, that sends a message when everything else is changing. At what point does he have to change the message to remain this dovish? The idea of, I'm not being gloomy, Tom, the idea of basically coming out and either accelerating bond purchase on the long end or doing something to adjust to keep yields lower.
Look, get comfortable with it. This is a new reaction function, and this new reaction function gets more powerful as this recovery takes hold. I think that's what's really important here. The Fed has told you what they won't do when inflation starts to pick up, and they're staying on message, Lisa.
Yes.
So if that recovery starts to take hold later this year, you know it's the story on the reaction function. We're staying on hold.
And not just that, but he also didn't talk down asset prices significantly, and that also crucial, not necessarily indicating concerns about asset bubbles and saying, who knows what a bubble really is.
Clinic time, you two are really good at this. Why is the difference in yield between the 10-year and the 30-year steepening out, where we've got a greater 30-year yield versus the 10-year yield? Lisa, go.
I think it's probably because people expect a lot more debt sales right now, because what you're not seeing is longer-term inflation expectations picking up materially. So it really is a supply issue, and also who's going to come in to buy.
You think so, John?
One line from Chairman Powell, a statement of confidence. Front end's totally pinned.
I agree.
2-year yield
I'm
totally
in the
pinned.
economic growth camp.
10s, 30s, statement of confidence. And that's the word of Chairman Powell. That's how he sees this bond market. And I guess that's more important than how I see it. Here's the price action this morning. Good morning to you all. We shape up as follows on the S&P 500. Here's your bounce back. Up 6 points on the S&P. Up a little more than 1/10%. In the bond market, yields higher by a couple of basis points. Have you given some of that cash to Kathy Wood?
Yeah, really?
She deploy it into Tesla for
Low
you.
blow.
Yields up a couple of basis points. Look, low blow. Kathy's flying.
Well, no, she got a huge outflow from her flagship fund.
Well, I mean, over the last few years, Lisa, I mean, come on, give me a break. 136.54 on a US 10-year in the FX market.
Wait a minute.
I mean, come on.
Is she going to buy either the Turks or the Caicos? I don't know which, but one of them. She had a pretty good year.
Euro dollar 121.59. Lisa, slightly stronger euro.
Yeah, indeed. We're seeing a little bit of dollar weakness. Meanwhile, as you guys are talking about today, we are going to get day 2 of Jay Powell testimony on Capitol Hill. But as Tom was saying, Vice Chair Clarida, Rich Clarida, speaking both at 1 p.m. and 4 p.m., possibly offering a little bit more guidance into what their easy monetary policy stance really is in terms of the reaction function, although I think the message was pretty loud and clear. 10 a.m., we're going to be getting new home sales in the United States. Strong, strong, strong. And the question is, how much momentum is there behind this as prices for those homes climb to record highs in a number of places due to some of the low interest rates and the move away from urban areas to more suburban areas. And then 1:45 p.m., I am particularly interested in this. President Biden is signing an executive order on supply chains. He wants to take a look at the shortage in semiconductors with particular focus on the supply chains out of China. A lot of people watching to see what he puts behind this to develop some of that capacity for manufacturing here in the United States, John.
I can smell some industrial policy brewing, Tom
Seriously.
Keene. Some onshoring.
Well, industrial policy brewing. I'm noticing yuan come in. Stronger Chinese yuan after a couple quiet days here. We're not through to new strength as well. But, yeah, everybody's feeling it out, John. The Washington-Beijing nexus is being redefined.
Let's get to this bond market. 10's up 2, 30's up 4. Let's bring in our guest of this morning, Rebecca Patterson, Bridgewater Director of Investment Research. Rebecca, fantastic to start the show with you today, so thank you for joining us. Let's start with that one little line from Chairman Powell. The run-up in bond yields, a statement of confidence. Do you agree with that?
For now, absolutely yes. I mean, you're having huge fiscal stimulus, huge monetary stimulus. It's not surprising, given the issuance coming and the recovery coming, that bond yields are going to be higher and we're going to see the curve steeper.
Rebecca, your colleague Bob Prince has talked about the challenges of working at the zero bound. I think we're creeping away from zero bound. How urgent is it for the investment community to get back to normal while we can actually calculate a real Sharpe ratio? I mean, can we sustain this artificiality we're in? Or does Ray Dalio, Bob Prince, and Rebecca Patterson have to get back to something different?
Well, we like to think that we can find opportunities regardless of the economic environment we're in. So we don't need to get back to something different. But certainly a lot of investors would be thrilled to have bond yields that could give them some income and return and diversification the way it did decades ago. I don't think we're going to get to that place anytime soon. As you all talked about at the top of the hour, Chairman Powell is being very clear that he's not unhappy with rising bond yields for now. He is very happy to see inflation coming back. And I think that's the big thing we want to be watching this year is, do we get an inflation surprise on the upside thanks to everything we're seeing, the recovering economy, the fiscal and monetary stimulus, the new Fed framework, and as you just mentioned, and this is a secondary factor, but still really important, what we're seeing with global supply chains. It's going to be a longer background factor, but it's definitely an inflationary one.
All right, we'll get to that in 1 second. I do want to ask you about Ray Dalio, your colleague, speaking earlier this week in a LinkedIn post saying that about 5% of the top 1,000 S&P stocks, top 1,000 stocks in the United States, I should say, are in bubble territory. How does this end? Do these continue to climb upward, or can they sort of be deflated without a broader correction?
Well, agreed. We try to look for bubbles all the time across every asset class. And as Ray said, we see maybe as much as 10 or 15% actually of total U.S. stocks in what we define as bubble territory. These are mainly smaller emerging technology companies, often that have not had sustained profits yet. A lot of leverage money going into these things. Bubbles can keep going up in the short term, but when you see all these indicators aligning, it tells you that their days are numbered. Will it take down the broader market? Given how small this is, it doesn't need to, but it's definitely something we're keeping an eye on. Overall, the total S&P does not appear to be in a bubble in our view.
Rebecca, I'm going to be honest here. Ray Dalio can pontificate about Bitcoin, but he and I, our knowledge on currency equivalencies is about zero. And I'm going to suggest Mr. Dalio probably got a brief from the adult in the room, Rebecca Patterson, on currency equivalency. How can Bitcoin be a currency? What is it?
I wouldn't call Bitcoin an alternative currency. I think, if anything, it's an alternative to gold or a digital gold. I think that would be the better comparison. You do have the same or similar supply constraints, and it is something that investors have been looking to as they worry about fiat currencies being devalued by all this central bank printing. But Bitcoin, look, if you're speculating on it, a lot of people out there have made a lot of money on it. As an institutional investor, I think we don't know yet if it's going to be digital gold. It may be over time, but I don't think we can say that with confidence yet. and that affects our view on whether or not we think our clients should own it.
All right, so going forward, what will be the trigger that'll signify that this is digital gold and will give a green light to Bridgewater to start investing client money in it?
Well, I don't think there's one green light that would have Bridgewater invest in it, but I think there are a couple things we'd definitely be watching carefully. First, we wanted to see lower volatility. I mean, right now, Bitcoin can move 10% on a tweet. That's not exactly a storehold of wealth for most institutional investors. So the volatility of Bitcoin is about 10 times that of euro dollar. It's still double that of the Venezuelan bolivar. So that gives you an idea. You want to see a lower volatility, more stable asset if you want to consider it as a storehold of wealth, a diversifier. I think secondly, and these are related, you want to see greater liquidity. And I think, and that takes me to the third thing, which is regulatory certainty. The more you get a real regulatory ecosystem developing around Bitcoin and other cryptocurrencies, the more other types of investors are going to be comfortable coming in. That's going to bring the liquidity. That's going to reduce the volatility. So I guess if there were one thing I were watching first, it would be seeing more regulatory certainty. And I'm not sure when that's going to come in the U.S.
Really important comments, Rebecca, and always great to catch up with you. Thank you. Rebecca Patterson there, Bridgewater Director of Investment Research. Tom, just think about that a little bit more, because it is important. It's the volatility that is stopping the institutional buy-in. It's the institutional buy-in that will lead to the lower volatility. And to Rebecca's point, it's the regulatory environment that will help the institutional buy-in and then ultimately lead to lower volatility and therefore more institutional buy-in. Really important point. It's a chicken and egg type scenario.
I totally agree. It's chicken and egg. I think that's really apt. And what's so important to me, it's not only the volatility and the idea of Bitcoin 2 times the Venezuelan bolivar volatility, but John, what is so important here is what Secretary Yellen said about efficiency, and that there's no proof of concept yet that Bitcoin can be an efficient transaction. They've got tangential second-order Bitcoins where they're trying to make that work, but there's no proof of concept yet. You know, she mentions fiat currencies. John, you can't buy a fiat with a Bitcoin.
Well, Tom, that's the point. Unit exchange, 1 point. Storage of wealth, the second point. It's storage of wealth, I think Rebecca Patterson, Lisa, seems to be leaning into just a little bit more.
Yeah, although I will say on the transaction front, there's a question of how much we could get a development there, because Square yesterday said that it bought about $170 million in Bitcoin, which raises their Bitcoin assets to about 5% of their cash and equivalents, and they basically are allowing people to pay with this. So at what point does that lead to greater confidence as well, John, perhaps on the regulatory side, but also institutional?
It's certainly going to raise the volatility of the stock as well, I imagine.
I actually was thinking it'll be a Bitcoin proxy.
Absolutely amazing. Coming up later this hour, Stephen Stanley, Amherst Pierpont Chief Economist, as we count you down to day 2 of Chairman Powell on Capitol Hill. For our audience worldwide this morning, good morning. Tom Keene,
if I was in the triple leverage Bitcoin fund, would that work out?
Perfectly.
Up 3 on the S&P. Thanks for the contribution. We advance 1/10 of 1%. This is Bloomberg.
From New York, I'm Karina Mitchell with the First Word News. Fed Chairman Jay Powell is signaling the central bank is nowhere close to pulling back on its support for the economy. At a Senate hearing yesterday, Powell downplayed concerns about inflation and rising yields. He says the economy is a long way from the Fed's goals on employment and rising prices. He returns to the Hill today. Meanwhile, Senator Mitt Romney says if Donald Trump decides to go after the Republican presidential nomination in 2024, he'll win it. Romney is the only Republican who voted to convict Trump in both his impeachment trials. He says he expects the former president to continue to play a big role in the party. Over to Hong Kong, where it just introduced its first stamp duty increase on stock trades since 1993. That led to a broad market sell-off. Shares of the Hong Kong Stock Exchange fell almost 9%. It was their biggest decline since 2015. Mainland-based funds sold a record of $2.6 billion worth of Hong Kong stocks. Golfing legend Tiger Woods was described as awake and recovering after a single car accident outside Los Angeles. One doctor said he had significant orthopedic injuries. Woods rolled his SUV in steep terrain and had to be extricated from the vehicle. Police says there are indications he was driving at a relatively higher speed than normal. And more fallout from that engine failure on a United Airlines 777. The FAA has ordered high-tech inspections of Pratt & Whitney engines that are used on 777s. A fan blade in the United jet's engine snapped, tore off another blade, and then the front structure of the engine. Global news 24 hours a day on air and on Bloomberg Quick Take. powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. Much more to come. This is Bloomberg.
I feel we have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
While we should not underestimate the challenges we currently face, developments point to an improved outlook for later this year. In particular, ongoing progress in vaccinations should help speed the return to normal activities.
Federal Reserve Chairman Jay Powell on the outlook for the U.S. economy, and it will be day two down on Capitol Hill very shortly, a few hours later this morning. From New York City this morning, good morning to you all. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Counting you down to the opening bell. Around about 3 hours away, 3 hours and 12 minutes. Here's the price action. Equity futures up by about 1/10% on the S&P. We bounced back by about 3, call it 4 points. No big moves here. It's in the bond market. It gets your attention again. Did we just get the green light to send yields higher? Push that curve just a little bit steeper. 136.71 on 10s, up 2 basis points. On 30s, 2.222%, up 4 basis points, Tom.
I'm glad you mentioned the 30-year bond, John. I think most of the interest this morning is farther out the yield curve, where you see that 4 basis move in 30s. John, to me, I dovetail that right into the pandemic news, where I've got a new death count. We were at 4,000, and we've come down to 2,315. That's a huge decrease in the right direction.
Getting better, Tom. The outlook getting better. And Morgan Stanley talking about that double tailwind of higher interest rates by the banks, better outlook, accelerating growth, maybe by the banks.
Get you out to 6 or even 7% GDP as Ellen Zentner and Morgan Stanley models. Right now to Emily Wilkins, Bloomberg Government, here to get an update. Emily, as I peruse the Washington Post, I see a jumble of politics trying to get to 2022. To do that, they have to affect policy, and policy is stimulus. Is the politics in Washington, what is Senator Perdue going to do of Georgia, blah, 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 is that politics permeating into the stimulus discussion?
I mean, I definitely think you've seen the stimulus discussion become pretty partisan. You are seeing Republicans, both in the House and the Senate, come out very strongly against the bill that Democrats are currently getting through the process. You heard yesterday Republican Senator Susan Collins say that she didn't think that any Republicans were going to wind up voting for this. Not that it's needed. Democrats think that, they are delivering on their campaign promises, and they think that if this recovery works out, it'll be bode well for them in 2022.
On a Tuesday morning, what is the power of the gentleman from West Virginia, and what is the distinction Senator Manchin can bring to it?
So the power of the gentleman from West Virginia will be determined by the power of the Senate parliamentarian, because it's all about the $15 minimum wage. Will Democrats try to raise it? There's some concern from Joe Manchin, the senator from West Virginia. There's some concern from the senator from Arizona, Kirsten Sinema. But look, that doesn't matter if the Senate parliamentarian rules today that Democrats can't use this wonky budget reconciliation process to move the $15 minimum wage. So we need to figure out what that ruling is, and then we're going to see what Democrats decide to do as a result of that.
Emily, meanwhile, as there are these deliberations on the fiscal stimulus bill, there's a question about infrastructure spending and some of the industrial policy. Joe Biden planning to sign an executive order today at 1:45 p.m. having to do with supply chains and looking into disruptions, particularly with semiconductors and other areas that are important to the United States. What are we expecting to come out of this in terms of policy?
So Majority Leader Chuck Schumer actually spoke on this yesterday. He called it a national security concern, and he indicated that there might be bipartisan support for not getting a program that's already there, but getting funding to that program to make sure that these supply chains are secure, to make sure that America is able to produce its own items, such as chips, such as semiconductors, such as things that are needed for daily use in Americans, as well as for national security.
Emily, this sounds familiar. National security concerns, the veil of which is used to go and do some policy to bring things back home. Is this any different to what we've seen before?
I mean, I think national security is something that usually you can find some bipartisanship on. Not always, but it does seem to be an area of a little bit more agreement here. I mean, look, Democrats, Republicans, they've already created sort of these programs to shore up these supply lines. It's now just a matter of making sure that those programs are funded.
The style of this administration is clearly very different to the previous 4 years, Emily. I'm trying to work out where the substance has shifted on this particular topic. Can you point me in the right direction?
I mean, you did see from the Trump administration, senators going through numerous foreign policy things. I mean, China comes into this discussion a lot, right? And you did see senators move legislation that then got passed into law that Trump signed. And you are going to see President Biden kind of continue that aggressive stance toward China, just sort of really making sure that particularly during this pandemic and other times that America is able to meet its national security interests.
There's a question, Emily, from a market's perspective, who gets this money that could be potentially allocated to strengthening the supply chain?
I mean, the idea, I think, is the hope is that for it to wind up going to American companies. I mean, if the idea behind securing the supply chain is that America is going to be able to make some of these products on their own. Of course, that is a long-term goal. In the short term, America has been working with its allies, such as Taiwan, to make sure that they're not going to fall behind on the semiconductor shortage.
Emily, it is a moment in February. I guess we're staggering to March, and we're staggering, am I right, to a speech by the President of the United States to Congress? Is that scheduled?
It's going to come. Obviously, it's taking a little bit longer. I mean, number one, just because what happened on January 6th, right? The riot on the Capitol. It's looking at this point like it might be in March. We are still expecting that speech to happen, though.
Emily, great to catch up. Thanks for your time this morning. Emily Wilkins there of Bloomberg Government. Thank you. Day two on Capitol Hill. The dominant factor, of course, will be Chairman Powell in front of the House Financial Services Committee, Tom. On that point, I will just raise the following. The chairman was asked repeatedly about the fiscal stimulus plan, and Tom, he is evading that like the plague. He wants nothing to do with it.
He should be. I mean, it's one thing to say that we need the stimulus on a macroeconomic basis, and he's using the PhDs at the Fed for that. But, John, it's completely inappropriate for him to weigh in on that, and they know that in their questioning. I really can't emphasize enough, John, the gotcha feeling that I got yesterday.
So the outlook gets interesting, doesn't it? Because in the next Fed meeting next month, Tom, we could have this really interesting dynamic where the Fed raises its forecast but leaves the dots largely unchanged. That's what I mentioned at the top of the program. I think that's where this new reaction function comes into its own and really starts to show how powerful it is, that they can raise the forecast, keep the dots almost the same if they do that. And as Neil Dutter of Renaissance Macro would say, that's almost passive easing at this point. And we could see that next month.
Well, that's really important. You've mentioned this before. So has Lisa, the idea that the market helps the Fed with their task at hand. John, what's important is March 17. And then on to April 28. And the meeting I would really focus on is the mid-year recalibration of June 16, because you're going to have a real sense of Q2 earnings then, and the idea of the might of America, the sustainability of 6% GDP.
Here's what I'm struggling with. You guys asked the question, Tom, you asked the question earlier in the show, what do I get from the steepening yield curve? And you're absolutely right that it is the pinning of the front end. But I'm looking at real yields, particularly in the 30-year, where you're seeing those Treasury yields lift. They are the highest, the most real yield. You're actually getting positive yield on 30-year treasuries now, the most since the start of the pandemic, which raises a question of whether this is a belief that the Fed will not swoop in to buy more at the long end, or whether people believe that we're normalizing. And this is a key question, and it does factor into risk.
Two complaints here, and I can't reconcile them both. So on the one hand, people are worried about high yields and they want the Fed to step back in. And on the other hand, they're worried about froth and they want the Fed to go away.
Correct.
Which one should they be doing?
Well, I think that people are trying to figure out which is the most important factor here. Is there going to be a froth in markets that ends up being destabilizing more broadly for the economy?
Coming up on this program, Stephen Standywagin, Amherst Pierpont chief economist from New York City this morning. Good morning. Live on Bloomberg Television alongside Tom Keene, Lisa Bramwitz. I'm Jonathan Ferro. With equity futures with a little bounce, this is Bloomberg.